a new affordable housing project lifts everybody. It also makes the landlord next door fix their building. It often brings new schools. It is always a wonderful center of new growth and new beginnings.
From New York City,
from London and Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
How do you compare the pleasure of being Secretary of State, Senator, First Lady with being a grandmother?
Well, actually, there are similarities. Negotiating with 3-year-olds is about as hard as anything I did as Secretary of State.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
A little bit of strike fever is kind of coming to fruition right now. And when people get concessions, when labor unions get concessions, other industries, other labor unions say, wait, maybe we should do that too, or we can do that. It's not a frivolous decision, but it's a strategic decision.
Wendy Schiller of Brown University on the UAW strikes, the conflict, the tension between that union and Detroit's big three, Ford, GM, Stellantis. There is a new deadline for further progress, midday today, Eastern time. And if we don't see a sign of that further progress in the next couple of hours or so, we've got a Facebook Live. We calling this a press conference, Bramo? What are we calling this, an address?
What is it? Yeah.
Facebook Live address, yes, taking place at 10 a.m. Eastern time with the UAW president. Going into all of that, this is how your day is set up going into the weekend. Let's get you to that weekend as quick as we possibly can. Your equity market on the S&P 500 positive here by 0.3%. That's a bounce from the biggest one-day loss going all the way back to March and all the banking difficulties that we had in the first couple of weeks of that month. In the bond market, I don't think the call was ever to see cycle highs after that tension, that those issues in the banking system in America back in spring, but to see cycle highs off the back of it 6 months later is phenomenal. We are pulling back a little bit. We're down 2 basis points on a 2-year to about 512, down 2 basis points also on a 10-year to 447. But to give you an idea, I don't know if you've been on vacation, hiding under a rock, in the last 24 hours, 2-year getting close to 520. 10-year in the Asian session, going through 450, just stunning to see.
We do this every day where we're completely jaded by it. You know, it's been sudden in the last 48 hours with the 10-year real yield out to 2.11%, I believe now 2.09. But John, you know, you get off the plane in New York, and what's the first thing you think about? What's a 30-year mortgage rate going to be? I mean. Does it go back out to new highs?
Pushing 8%.
You know, do you nudge up?
I think number one question we've asked is the right one. OK, that's the mortgage rate if you wanted to go and get a mortgage right now.
Right.
How many people are going to get a mortgage right now? So you've got the price of money and then the price people are actually paying, given the agreements they've made over the last several years. So when do we start to see that great refinancing? Where in our future is it?
And again, it permeates for me down to a real yield and an inflation-adjusted yield. Let's remember 2.x% in the United States positive real yield affecting all, and the fiction of the United Kingdom where the real yield's still a massively negative statistic.
The unknown. Tons of uncertainty about the inflation story. But Tom, if they are seriously high for longer, if they're taking away all those cuts for next year, and if you're going to see inflation continue to make improvement, disinflation, then that real rate, Tom, gets even more destructive, doesn't it?
Absolutely. There's no question about it. And you know, we can go to the residual math here, but that's going to be a huge theme into October. One of the themes we know is Keith Naughton and our team in Detroit will be glued on Facebook at 10 a.m. maybe to find out what modern UAW strategy is. If you're weaned on Walter Reuther, if you're weaned on George Meany of the AFL-CIO, it's a whole new world to provide wisdom with huge depth and perspective. Naughton of Detroit. Keith Naughton, I'm just going to cut to the chase. It's a whole new world after all. What have you learned about this new negotiation of 2023?
Well, it's really guerrilla tactics, Tom. You know, they are taking out different plants at different times. They're trying to keep the companies off guard, keep the companies guessing. So, yeah, what we will get today is UAW President Shawn Fain will announce the next round of strikes. They've already struck 3 plants, 1 at each company, as you know, and they're going to probably strike 3 more. The question is which plants they'll be. Will they take down the big pickup truck plants that provide most of the profits for the big 3?
Each of these companies has a different character. I think that's underplayed. We sort of amalgamate everybody into Detroit and their immense support of the Detroit Lions. Forget about it. Which company are you watching? Which culture in Detroit will give you signals about a successful outcome?
Yeah, I think the company that's in the lead is Ford. Ford has traditionally had the best relationship with the United Auto Workers. They've actually made 4 offers to the United Auto Workers so far. They were the first to give an offer. As you know, Bill Ford, the executive chairman, great-grandson of the founder, he showed up to make a proposal in person, their most recent proposal. Shawn Fain stood him up.
Keith, what's the big holdup? Do we have a sense now? Is it really the salary? Is it the mix of products being manufactured? Is it the sense of guaranteed workers at a certain level, at a certain number of plants?
Well, it's really all of those things. They are very far apart on wages. The union has come down from a 40% request to a 36%. And the best the companies have offered so far is a 20% from GM and Ford, 19.5% from Stellantis. So there's a very wide gulf on the wage demand. But yeah, they're hanging over these talks is the electric vehicle transition and the battery plants that all these automakers are building that are not yet organized by the UAW. The UAW wants to make sure those future battery workers will get the same wages and the same benefits as the existing UAW workers.
Keith, when you say that these sides are very far apart, you talk about the distance between the two, and I think about how inventories are going to start being bought down of some of the dealers, the auto manufacturers as well. How much do we expect auto prices to increase? How long does this have to go on before people feel it materially when they go buy a car?
Right now, inventory is pretty good. The automakers really built stocks in advance of this. So industry-wide, the day's supply is 58, and what's considered ideal is 60. So right now, there's a pretty good inventory situation. But the more plants come down and the longer this goes, then it starts hurting.
Keith, what's your timeline? The one thing I can't get out of experts, I mean, I got a lot of punditry and that, but you people are so informed. I mean, even Craig Trudell over here in London is somewhat in the game. What's the Bloomberg timeline, your best guesstimate of this strike?
Well, we've spoken to one analyst who thinks that it can run to the end of October. It's very hard to know. There's some stuff that came out overnight, some texts from union sources that it looks like they really want to make this go for a long time to inflict pain. So it doesn't feel like we're very close to a resolution.
So are we talking F-150 now, Tom? Are we going that far?
They're going to go to the emotion of pickup trucks, which is the lodestone for certainly, well, I'm going to go all 3 as an amateur, but I defer to Keith on that. But
Keith, just to make it really simple, is that like the last thing that they reach for, or do you think that's the next thing?
It could be the next thing that they reach for. If they really want to inflict maximum pain, you take down the Ford F-150, the best-selling car in America since Ronald Reagan was president. You take down the Chevy Silverado, you take down the Ram pickup truck. Those will cause pain immediately.
Well, Keith, the big hang-up here is how much money they have left at the UAW to keep paying people who strike. I mean, are they going to try to use it up? Do they have a limited amount of time, or do they have a lot of runway?
Yeah, so they have $835 million in their strike fund, and they're paying $500 a week to strikers. But so far, there's only 12,700 strikers because of this targeted approach they're taking. That's how they can conserve money in the strike fund. However, The companies are laying off people because there's this ripple effect that happens when plants go down. And the union has agreed to pay those people getting laid off as a result of the strike from the strike fund as well. So that will deplete it faster.
Interesting. Keith, thanks for the update. Keith Norton there of Bloomberg, looking ahead to this Facebook Live event at 10 a.m. Eastern Time, ahead of the supposed deadline of midday Eastern to make sufficient further progress. I sound like Chairman Powell over at the Federal Reserve, but we're looking for sufficient further progress in talks, Tom.
Well, you know, I'm glad you brought this up. And, John, the pickup truck thing is certainly very emotional, but I was thinking, you know, based on all my knowledge and heritage here, you know, I just think UAW, they really ought to go after the Pinto and the Javelin. I mean, that's really... You know,
do you want to explain what the Pinto and the Javelin is?
The Pinto and the Javelin, to foreigners like you, is when we started buying foreign automobiles. They were so bad, they were so poorly designed. There was also something called a Suzanne Vega. There was a Pinto.
You can't say he's a foreigner in the UK when we're in London. You can't say that.
No,
do that when I'm in America.
I know, exactly.
No, but
I mean, it's like you
the
can't
bottom
do it
line,
there either.
no, but seriously, when did we start buying foreign automobiles and why? It was because Detroit invented and engineered these monstrosities. They were all glass. They weighed a ton. They couldn't go around the corner.
The thirst for bigger cars.
And we said we want to buy a Renault. We called it a Renault, I think then, and a Puget, and the rest of them.
Say that again. Say that again. The last one. The French
a Puget. It was a Renault. You wrote a Renault Dauphine. The rich kids' fathers had a Renault Dauphine.
Did they?
And the rich art students, the art chicks, they had a BMW 2002.
How much of this have I got to get through? Another 30 minutes, something like that. You're going to stick with us at home? I hope so.
Yeah.
Henry of HSBC is going to join us shortly. Seema Shah a little bit after that. All of that in the final 30 minutes of whatever this is. Live from London. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see in myself yet.
He never stopped, for what it's worth. There was a break of about 3-4 minutes, but the conversation continued, and I'm still none the wiser. If you are just tuning in, congratulations. Your equity market on the S&P 500, positive here by 0.4%. Session highs on the Nasdaq as well, up by 0.7. A lift off the back of the biggest one-day drop going back 6 months to the month of March. In the bond market, cycle highs, a 2-year, a 10-year, a 2-year earlier this week pushing 520, backing away this morning, down about 3 basis points. But to see a 30-year in the 450s, a 10-year in the 440s, and briefly overnight in the Asian session, a 10-year at 450 is just absolutely phenomenal. The Fed might be signaling maybe they're done hiking, but it's going to be at this level for perhaps a whole lot longer, based on the way we've internalized that message in this bond market, Tom, this week.
George Saravelis gave us a window. He published literally in the last 30 minutes their outlook into the end of the year, and every shop has to do that. How do you publish an outlook with yields moving like this? You got to go, what if higher? What if lower? What if disinflationary trends click in?
Well, you had a dummy run from the Federal Reserve. How did that go on Wednesday? They published an outlook.
Your camp.
Then got a bucket of freezing cold water and just did that all over it and said, yeah, about that, no.
To me, I just think that there is one logical conclusion that we can have, and I feel like people are kind of dancing around this, which is that no one in the U.S. is paying the rates that are exactly being quoted,
the transmission's
except for the U.S. government. That is it, right? Basically, the new bonds that are being issued, and even then, only on the margins. So how can we really say that we've seen the effects of this, right? But then how do we say that we are ever going to see the effects until 10 years later when all of these bonds mature, et cetera? So at a certain point, isn't this an economy that's just completely immune to rates and are going to have to go a lot higher than people previously thought? I mean, why is that not
we'll work through it.
part of the discussion?
For corporations in the next year, high yield, we know there's a maturity wall out there.
Right.
They'll have to pay it. If you wanted to buy a new car right now and you weren't paying cash, you'll have to pay it. It's just taking longer than I think we thought it was going to take, particularly when it comes to the mortgage market. Housing, I think housing's just its own beast. 30-year fixed, you're holding on to that 2% mortgage, you're not letting go, are you? So that's its own beast right there. But other parts of the economy, they'll feel it over time. Whether you need to wait or go further is part of the conversation. I think we're going into this quarter where we're hearing the same old story. That's the problem I've got with this fourth quarter. The fourth quarter, it's the economists that cried recession, and no one believes them anymore.
Right.
So now we're stacking up a whole new load of issues. Student loan repayments, headwinds coming from energy, et cetera, et cetera. No one's buying it anymore. No one's buying it anymore at all.
People believe in the strength, and that's why we're seeing yields get to such highs, even though everyone was saying, buy the long end, it's going to definitely go lower and go back to something more normal.
5 days into this sojourn in London, and after our great credit conference, we haven't even talked about Jim Zeltner on fire yesterday.
He's fantastic.
At the credit conference. I was like, you guys were going with him as bond people, and I was like actually listening to the state of the industry, which I never think about, but very, very cool. Thanks for the comments on that. The Julianic Memorial Credit Conference that we did there, I thought that was very good yesterday. We needed a voice near the end of our sojourn to provide balance and a view forward. There's no one in London that can do that like Janet Henry, global chief economist for the Hong Kong and Shanghai Banking Corporation, wired into Asia, literally like no one we talked to. You've got a lovely view. And then there's China. What does HSBC, with all of your contacts, say about the stability and the economic recovery of China?
HSBC has a perhaps more balanced view of China than some of the hysteria that hit the markets not so long ago. I think we're not going to get any quick answers one way or the other on China. And we need to learn to live with that. You know, financial markets always want to know with certainty where things are going to be in 2 years' time, and they want to price it today. The fact is, in China, what we have seen recently is some signs of stabilization in the economy. Industrial production showed some improvement, retail sales showed some improvement, credit data is showing some improvement. Are there still major challenges in the property sector? Yes, and we are seeing a gradual rollout of policy stimulus that is now being reflected in monetary data. Are there major issues in local government debt stocks? Yes, there are, but are they providing liquidity? Yes, this is a multi-year story of ongoing stabilisation, and the next round will be structural reforms to deliver the long-promised higher quality of growth.
On monthly and 3-month annualized, and within your research note, we see a disinflationary tinge. That dovetails with Steve Major's long-term conviction of price up, yield down. That's been tested the last 72 hours. Do you guys stand with a disinflationary tendency which filters in to lower yield?
Well, from a macroeconomic perspective, for the last 2 years, Tom, as you know, I've been talking about a deterioration in the growth-inflation trade-off, a different mix of lower growth, higher inflation, and that probably requires a different policy rate level than we were used to in a pre-pandemic era. Yes, we have some disinflation, but there are plenty of risks out there. Even the Fed's Goldilocks view that they set out at the FOMC, the level of uncertainty around that they are admitting is quite high. But by the same token, it's not so long, as you've already highlighted, that everyone was forecasting a recession. First half of last year, this year, second half of this year, now a soft landing. The fact is, this is an unusual cycle. The last 3 years were unusual. Why does the market keep fitting with the idea that this is going to be a very ordinary downturn with a very ordinary Fed response?
Has something changed, Janet, from your perspective, the relationship between the labour market and price pressure, just based on those forecasts? And Chairman Powell himself hesitant to ascribe a narrative to a median projection, but let's have that conversation anyway. We have done over the last couple of days. They're essentially saying we can get inflation down to 2 with unemployment not climbing much above 4%. What do we learn from that?
We've learned that they are extrapolating what's happened so far.
Right now?
Yes. So you're right. I mean, it's remarkable. We've never been in the recession camp. We've been in the more protracted slowdown, the rolling recession camp, a couple of years of sub-trend kind of growth. But now the Fed has overtaken us on the unemployment rate. You know, we only had unemployment at 4% by the end of the year, but we've got it at 4.5% by the end of next year. The Fed hasn't even got that, having previously said that it was going to rise by more. It has been extraordinary that wage growth has gone from nearly 6%. To just over 4%, but the recent progress has actually been a bit slower, and everyone's talking about the strike. We don't know. It could be that actually there are other areas of the economy where, because of collectivised wage bargaining in Europe, because of public sector pay in the UK, because of strikes in the US, that it's not a linear story. Actually, it's a bit rocky on the way down, and the disinflationary process, as we've discussed before, is not continuous. We've got other areas of inflation volatility, and the markets are going to have to accept that they really are willing to keep interest rates higher for longer.
For people who go on the Federal Reserve website and they open up the summary of economic projections, should they view them as forecasts or aspirations? What are they?
They should view them, obviously, that every central bank, given their inflation targets, their inflation priorities, that is their primary goal, and they will do what is required to get there. Obviously, what we got in the Fed projections, and to some extent we've got in other central bank projections as well, is that they're almost willing to take a little bit longer to get there. The Fed is saying it's not going to be at target till 2026. And they have said that their central scenario is now that they can get there by being a bit slower, a bit more patient about getting there. They can get there without a traditional recession when the economy has some kind of deep contraction. But as no one ever reads page 2, page 4, question 4, question 5, what's your certainty about this range of forecasts? It's still very high. It's not where it was during the pandemic, but it's still high.
Are you basically saying that what we're seeing this week in markets is a sea change about our understanding of central banks' patience with such high inflation, that they will tolerate it for quite a bit longer, and that means it will become more entrenched in a way that people previously had not expected?
I'm not saying they will tolerate it staying at these levels, and they certainly will not tolerate any signs that it's reigniting, whether that's from wage pressures or elsewhere. They need to see further progress. They need to be confident that that progress is going to continue. And obviously financial markets, at the first sign that maybe a central bank is done, is celebrating the fact that the next move is going to be downwards. And actually, the more that financial markets do that, the more likely it is that a central bank that's trying to tighten financial conditions actually stops raising rates. So I think that what they're telling us is that they are determined to drive it lower. They might be patient about the timeline with which they get there, but they're not going to take any risk that it becomes entrenched. You had that from the Bundesbank again overnight.
The game theory that you just laid out, does that mean that the yields that we're seeing now are finally self-fulfilling and will actually create or foster the tight credit conditions that are necessary to get to the Fed's and the other central bank's goals? I mean, in other words, do you think that these are sustainable, or do you think that this is what we need to get lower?
I think how financial markets react, obviously I'm just a macroeconomist, will be a function of what central banks obviously do. But the central bank is trying to tighten financial conditions. It's trying to slow demand. They still think by slowing demand, they can impact on inflation and ensure that the inflation continues to slow. But we keep talking about all of the uncertainties that are still out there. We've got a renewed inflation volatility, not least from oil and from food. We've still got uncertainties regarding labour markets. The truth is they don't know what they're going to have to do, which is why, as well as saying we're ready to raise rates higher, we're ready to keep them on hold for a very, very long time, it's actually all still about the data dependency. So, yes, they're still watching all of these factors as long as they can see progress, whether it's a consequence of higher yields, whether it's a consequence of what's happening in equity markets, whether it's a consequence of what's happening in spending behaviour, as long as they see the inflation data coming down, that will be enough to become more confident about the medium term.
I have to ask this question. It's with immense respect for what HSBC and like Bloomberg went through with COVID. I mean, we've heard from the quarantines of HSBC and the travels during COVID in China. You walk out of the Bloomberg building in Hong Kong, you go across that historic tramway, and there's one Queen's Center, your building, your place. It's the foundation of Hong Kong finance. What's the stereotype right now we most get wrong about the new Hong Kong?
That is a very broad question.
Well, it's a Friday, so we go with broad questions.
It is a Friday. Yeah. But actually, you know, as an economist, I always think that sometimes we think about countries. You know, obviously as an economist, I love it that people want to talk about countries. They want to talk about central banks. But a lot of the things that happen, whether it is in Hong Kong, whether it's in Dubai, whether it's in London, whether it's in New York, is actually more about sectors and it's more about companies. So whatever view you have regarding the macro story, when we're thinking about where the true transformational shifts lie in the coming years, and a lot of it is in technology, there is still a lot of dynamism, and there's still money being provided to companies.
I'm going to make some news here.
That.
10 seconds. Are you a Hong Kong
trying to cause
optimist?
some trouble? That's what you're trying to do.
Am I a Hong Kong?
Are you a Hong Kong
Absolutely. As
optimist, given
someone
all
that
that's
lived in Hong Kong for 5 years, I'm still a Hong Kong optimist.
Are you done on that subject?
I think it's important. I think HSBC, Steve Major,
agreed.
Janet Henry, these people have a prism in there. You know, all the stereotype blather we deal with. Our Steve Engel.
Since we're causing trouble, I miss David Bloom. I miss David Bloom.
Yeah,
so much.
Well, he's trouble.
He was great.
You know,
he was trouble too.
He was trouble.
Janet Henry, thank you. Of HSBC. Appreciate it. It's good to
Fabulous.
see you. If you are just tuning in, welcome to the programme. Equities right now positive by 0.4%. Yields a little bit lower by 3 basis points to 446.81 on a 10-year. Seema Shah of Principal Asset Management is coming up very shortly, Bramo, to round out our week in London before you head off to New York.
It's been quite a week, I have to say.
What's your big takeaway?
My big takeaway is that people are pricing in higher for longer, and people are pricing in this idea that it's going to take a lot longer to get inflation under control, and that suddenly there's a question about what that does to the fundamentals underpinning the market. If rates really are higher, suddenly you get those tighter financial conditions that weren't there earlier when people were just expecting the Fed and all the others to cut.
Which I'm listening to people pushing away from that, like Janet Henry and Ms. Malik over at Nuveen. She was starkly opposed to that cautious outcome, starkly opposed.
It was the first time, I think, in the last couple of days where we've started to see those high yields hit risk. I checked high yield spreads this morning. At least they're a little bit wider.
Exactly, that's
given what's happened in the bond market, because they haven't been at all. They're still sub 400 for what it's worth, still pretty tight on a historical basis. Equities right now positive by 0.4% on the S&P 500. To wrap up our week in London next with Seema Shah of Principal Asset Management. Live from the city, this is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
My feet are firmly on the ground. We've played 5 games and we've started off well, but it's how you end that counts.
The mood around the club seems to have changed. Big Ange, has he changed that?
He's had a very, very big impact. We wanted a manager that we need to go back in time to our real DNA, and we needed somebody that understood that, you know what, there's no easy fix to win. We're very much a club that believes in the academy, producing players that can become hopefully superstars at Tottenham. We're not a club that can buy success. That's the reality, and we have to understand that. And we needed a manager that was completely aligned with our philosophy.
better mood around Tottenham Football Club going into the North London derby this Sunday. That was Daniel Levy, the Tottenham chairman, talking about the impact of the new manager and the impact that manager has had at the club this season ahead of Sunday's derby against Arsenal. You can watch the full interview with Daniel Levy on Bloomberg's YouTube page and at Bloomberg.com. TK, that's out
play
there
it down.
right now.
Come on, this thing went worldwide, folks. For those of you that don't follow this foolishness, this is the most substantive interview in English football in ages and ages. I looked at one German website which tore about, John, your work and also two other outside sources on the future of Mr. Kane and when he comes back to the United Kingdom. What I don't get is Daniel Levy, with no government funding, with a lot of bank loans, built a palace. He described to you the free cash flow, and he's sitting there crying poor that he needs an academy to build the team. I don't buy it for a minute. Is he one of the rich guys like the Saudis and the rest of them, the Qataris, or is he as poor as he led up?
I wouldn't use the word poor, that's for sure, but I wouldn't use the word rich or as rich as the likes of Saudi Arabia. And competing with sovereign nations is really difficult. The beauty of the stadium that Tottenham have built is it's multi-purpose. So the pitch can go away, then you can have a music concert. The gate receipts, he was talking about the numbers, north of 100 million sterling. That's just for football. Another 30 million.
So Katy Perry can go in and go if it's hot.
Beyonce,
and it's cold,
she might want to sing that. Let's see if that sells out. I don't know if it will or not, Tom, but ultimately, yes, and they can raise more money doing that. It's made the club, as far as he's concerned, a lot more sustainable financially and put it on a really good path. The question now is whether he is open to a stake sale. He says he is.
Yes.
He says, like he always says, I've had a duty, as always, to lead the club for the best interest of the stakeholders and the fans for that matter. And if they get an offer, you just get a sense that maybe this is a moment where he might be a little bit more open than he has been in the past.
Because of the impact of this interview, two quick questions. Is he looking for a minority sale, a stake sale of 10%?
Unclear, don't know.
Or is he talking about sale of the franchise?
Unclear, don't know.
What would they go for?
All I do know at this point is there is huge demand in British football. And we've seen takeover after a takeover happen, particularly from the United States. What would a number? I can't throw a number out there. I can say that the Glazers wanted something close to 7-8 billion for Manchester United. They weren't getting the number they wanted.
Okay.
Could it be close to 3, 4, 5?
But it's closer to London, and they have the derby. Okay. Well, who's your next interview with?
There's a list.
There's a list?
We've got to nail down the Glazers. So a lot of people giving me feedback to get the Glazers.
Look at Jim Selnick, and it's a Rochester interview.
Get Todd Bowley out of Chelsea. Try and make that happen too.
Okay. Well, congratulations.
And the leadership over at Newcastle. Let's
huge
do that.
impact. And look for David Hillier and all of our English football coverage with Bloomberg News. Right now, Seema's going, is this what I showed up for? Seema Shah's with his Chief Global Strategist, Principal Asset Management, as we finish strong in our week in London. What have you learned of the last 72 hours of central bank football? What's the summary for the principal group?
That the conclusion of the London derby is clearer than what the central banks are speaking about.
Do you have tickets? Excuse me, guys. Do you have tickets for the derby?
I don't.
Continue.
No, look, I think the central banks don't really know what's going on. They're really confounded. We've heard from everyone that actually Powell is a little bit confused. As he talked through the conference, the questions, actually, he gave very, very unclear answers, I think. It was quite confusing.
Shah in the same territory as Pharaoh.
So what's your takeaway? I mean, right now what the takeaway has been from the market is that higher for longer. That seems to be the theme. Do you push back? Do you think that we're finally seeing rates at levels that will actually be restrictive enough to bring inflation much lower and to actually create some weakness?
So I don't think rates need to go any further than where they are today, because I still, we talk about the lags continuously. I think at some point the lags are going to come in. Timing is difficult to call, but they will come through. And then if you do another hike, you are risking a bit of an error. So that's what I think. I think, for the higher for longer, it makes sense in light of the kind of 1970s experience, which inevitably is going to be very fresh in their minds. And that probably is what keeps them from cutting rates a little bit longer than maybe they should do. So we're pushing it out to probably the second half of 2024 for the first rate cut because of that concern. What could happen to inflation?
Just taking a step back, are you more pessimistic on risk or less pessimistic on risk after what we saw over the past week?
I'm actually nowhere on this one, which is unusual. It's extraordinary. But the reason is, I'll explain why. So I think that the market is really going to be very range-bound through the first half of next year because there is no very, very clear narrative. If you have high growth, then you have high interest rates, so it's offset. If you have low growth, it's offset by interest rate cuts. So until you get to a point in the second half of the year where you do get an economic downturn, but then it becomes quite clear that the economic downturn is shallow, and then that's combined with rate cuts, that's when I think when the market can really rally with some conviction.
I've heard 28 flavors of equity belief and conviction into 2024 on this trip. What is, you're writing an outlook now to get to Q4 before your, painful 70-page 12/31/23 outlook. What's your conviction on equities?
That they're range bound. That is a clear conviction. If I look across, I think that the US is going to outperform Europe, certainly the United Kingdom. So there is still an element of US exceptionalism. I think that the large cap space is going to be challenged, but I want to be a long-term investor in that.
So you want to
large cap
capture
space.
dividend growth. I mean, just as simple as that.
Yeah, I think that is what it is. We're thinking about income at the moment. That, I think, is the one thing that we can have a little bit of conviction on.
Preferred shares? How's 60s of me? We're talking Pinto and Javelin. Preferred shares?
Well, the interesting thing about preferreds is that, they were beaten up earlier this year. A lot of investors, even as actually the bonds came back, investors felt like they'd been permanently damaged by the events. And they lost conviction, but you've actually seen everything start to creep back. So I think preferreds could be on a decent rally.
I love, I love preferreds and warrants. It's great. I feel like I'm in England, I'm in London, it's railways to India.
Just let's end on this note, that as you take a look at your caution from earlier in the year, and the fact that everyone who was cautious ended up having real regret and then saying, okay, well, we shouldn't be too cautious and we can't predict recession. Does that make you fearful of doing the same thing again? Has that sort of been a bit of shell shock that you feel across the street right now?
I think so. I think everyone is confounded by what's happened with the economy. They're confounded by central banks. And inevitably, as you try and switch your calls, you're worried that, oh gosh, everything that I thought is going to start coming through. So you have to have a view on the fundamentals. And for us, the fundamentals I still believe in the lags of monetary policy. I think it will come through, but I think it's going to take a little bit longer.
Seema, this was great. It's good to see you in London. Thanks for being here. Seema Shah of Principal Asset Management. Tom, we've got 2 more minutes left. You found more songs?
I teared up. Henry emailed in. Thank you, Henry, for watching. The surveillance team's interviews this morning from London with Stubbs, Rochester, Malik, and Shaw have been worth more than the cost of a month's cable TV subscription.
Very cool.
The benefits of your London week-long relocation have been invigorating. See ya in late November.
Is that your ghost account, or is that real?
No, that's real. I mean, I just think.
Believe that.
I've got no idea.
After Thanksgiving, in time for holiday shopping, you can do another interview with Daniel Levy.
Okay. Let's watch this interview. Daniel Levy, catch the full interview if you can over the weekend on YouTube, on our YouTube page or on Bloomberg.com. Look out for that. On Monday, very cool conversation coming up on Monday. Permacrisis, the latest book with Mohammed Al-Arian, Gordon Brown and Michael Spence. All 3 together, Tom. A conversation about their latest publication.
Fascinating, and particularly with the former Prime Minister, to see what Gordon Brown says about New Labour, about their dynamic, how they respond to what the Conservatives are doing.
There's so much to talk about. Also, that title, in and of itself, Permacrisis. Brammo.
Doesn't sound like Michael Spence.
I'm looking your way, Brammo. This is your kind of book.
I mean, this is the whole thing, is that we've been going from crisis to crisis, people planning for crisis, and now we didn't get a crisis, and now people don't know what to do with themselves. If we're not getting a crisis, what are we having right now?
The laureate,
so confused.
The laureate Spence is going to push against permacrisis. He is, optimist.
It's going to be very cool. This was great, guys.
This is great. Thanks to our team.
Thanks for coming back to home turf for a little bit. Back to New York.
Hot brown water was great.
Okay. I'm pleased you didn't insult too many people, Tom.
Thank you.
Just a few. We'll leave it there. Let's try and get TK on a plane and out of London unscathed. From the City of London, thank you for being with us all week. Thanks for the hard work of the team, the producers, for everyone who's put this week together for us. We appreciate it. Live from the city. Good morning.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself, self-made day trader.
Yes.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
Good morning from New York City. For our viewers worldwide, I'm Matt Miller, in for my good buddy Jonathan Farrow. We're looking at equity indexes, futures that are rising. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Coming up, futures edging higher at the end of a bruising week for investors. The bond rout taking a breather after yields touch multi-decade highs, and the clock is ticking with a shutdown and more strikes on the horizon. We begin with the big issue countdown to 12 p.m. Eastern.
If you look at the UAW.
The UAW strike.
The auto strike.
There isn't a deal that's been negotiated.
Potential for the strike going on longer.
What message does it send for wage earnings growth and how sticky wages may be going forward?
What is that going to do to wages across the board for labor?
Higher wages and margin compression.
That certainly could be inflationary.
The Fed's going to keep a very close eye on that.
It's going to make the Fed's job a lot harder.
Makes the Fed's job even tougher to constrain inflation.
Wage gains is something that, complicates their mandate.
The labor market remains very tight and wage pressures really haven't eased sufficiently.
It's definitely problematic for the soft landing.
The big question for all of us, looking at the economy, looking at the markets, will it have demonstration effects?
We don't know if there's a larger and more prolonged strike, exactly what it would do.
This is unprecedented.
Joining us now to discuss is TPW's Jay Pulaski, as well as Academy's Peter Cheer. Let's start with what to expect from rates going forward. I mean, I would have thought a couple days ago it's a perfect time to buy because they couldn't go any higher, and yet they continued to march higher. Jay, what do you think about rates? Is it a screaming buy?
Well, Matt, great to see you. I think the rate backup here really demonstrates the depth of belief in recession within the bond market. I mean, the way I'm viewing the last couple of days is that the good news is that the Fed is more in line with reality than at any point since COVID struck us back in March of 2020. I was on the program several weeks ago and suggested that the Fed was going to double its 2023 GDP forecast and raise 2024, and that's exactly what they've done. They took down unemployment, and basically they took recession off the table. And from a risk asset point of view, I think the opportunity is much more in equities than in bonds, because essentially what we've done is we've traded a recession call for 2 fewer rate cuts in 2024. And I think that's absolutely a great trade for risk assets. And as I see it, the Fed is now validating what the other cross-asset markets have been suggesting, namely that we're in a bond bear market, that the commodity bull market, commodities are up almost 8% over the past month, validating that, validating the rise in earnings revisions that have been supporting equities and will continue to support equities, and supporting the thesis that the credit market has been telling us, which is that everything is fine. So we're on a hunt for the return to stability, which is going to unlock the $1 trillion that went into the money market funds. And I think we've moved a lot closer to stability, believe it or not, after the last couple of days than we were a week ago.
Peter, don't we have to see at least another hike from the Federal Reserve? Because, you know, as Jonathan was pointing out earlier on surveillance, they have been saying for a long time they believe they're sufficiently restrictive, and yet the economy continues to grow, right? And yet the labor market is still very strong. And we could get more inflation coming out of, obviously, this strike, considering it's looking like it's going to go on a little bit longer. So aren't they going to need to raise rates more to really be restrictive?
I don't think they're actually going to need to do that. I think if you look at the last job report, it was perfect, right? We actually had labor force participation increase. So I think as the data keeps coming in, it is going to give them enough reasons not to do anything, which is what I think they're looking for. Up until recently, they've been looking for excuses to hike, now looking for excuses to do nothing. And I think the data is going to come in with that. I think people forget, too, just how good the consumer was and corporations were at locking in long-term yields. They borrowed longer term, even auto loans extended. Every part of the borrowing structure extended. So all these rate hikes, it's going to take a year, 2 years, 3 years for it really to start impacting most people. So they are better off leaving this on hold, letting real yields be high. And I think they're starting to get a message, too, a very strong message from small and mid-sized businesses. Enough is enough. Borrowing costs are getting hard for us. It is difficult for us to invest. And I think they're going to listen to that as well.
Peter, I want to drill down on something that you're implying here, that long and variable lags truly are long. A lot of people have made the argument, including Jan Hatzius from Goldman Sachs, that they aren't really, considering the incredible transparency, the fire hose of information flow that we get, and the fact that nobody has floating rate mortgages anymore. We're all fixed post-financial crisis. Do you really think these lags are still taking 6, 12, 18 months to come through?
Yeah, if anything, I think it takes longer, right? If you had a 3-year on average, you'd already be getting impacted. But people extended to 5 years. Corporations extended out to 8 to 10 years. So it's taking a lot of time for these higher costs to impact stuff. It's affecting some decisions, but it's not affecting current, capital bases. So I do think it's going to take much longer than people realize for this to happen. And the people who do have leverage loans, short-term debt that's rolling over, they are starting to feel the pain, and that's where the noise is going to come from. And they're going to say, enough is enough. Let's just hold off and see where this plays out.
Jay, what do you think about the extra dot in the plot? I mean, it was 12 Federal Reserve members who said we're going to need another hike. Are we going to need another hike? And also, does it matter? I've heard so many people say 25 basis points doesn't matter. Does it matter? Because we'll freak out on the day that they do it.
Well, that's natural, right, Matt? But yeah, to me, dot plots mean squat. In other words, the Fed's history of being right on the future is very poor. Guys like us that make a living getting the markets right would be out of business if we had the track record that the Fed has in predicting what the economy is going to do going forward. So I pay virtually no attention to the dot plot, never really have. And my focus, again, we're focused on the return to stability. We're focused here at TPW Advisory on the rate cutting cycle that is underway around the world, Brazil most recently, just yesterday, as opposed to backward-looking rate hiking cycle. We're effectively done, whether or not, to answer your question, they raised 25 basis points or not. The point is that the Fed has validated the higher growth for longer. We're not going back to 2010, 2019, low growth, low inflation, et cetera. We're in a new environment with new industrial policy. Global growth is accelerating and inflecting upward, and that is what we need to see for equities. And I expect as we move into earnings season and we continue to validate 2024 double earnings growth for the S&P, equities are going to do just fine.
All right, everyone piles on the Fed, but I feel like, they may be guiding us right now to a soft landing, which would be pretty admirable. Of course, there's still a massive threat. A few threats, but one I think that towers over the others, and that is the strike. Detroit's Big Three bracing for even more walkouts as a deal with the UAW remains elusive. A week into it, the union's president, Shawn Fain, set to announce the next steps at 10 a.m. Eastern. Bloomberg's Kayleigh Lyons joining us for more. So, Kayleigh, we'll hear the Facebook Live announcement in just about an hour, and then I guess in a couple of hours, that's the deadline that he's set.
Yeah, right. Set for progress in these talks with the big three automakers. And so we'll understand when Fain speaks less than an hour from now exactly how they plan to expand this strike, which to this point, a week into it, has remained relatively narrow in scope. We're just talking 13,000 workers who have walked out of 3 different facilities, one per automaker, a Ford plant in Michigan, a GM one in Missouri, and for Stellantis, one in Ohio, all that make profitable vehicles. And according to S&P Global Mobility, it's affecting output of these automakers in total by around 3,200 vehicles per day. The union, though, intentionally left room open to begin inflicting more pain if necessary, if they couldn't get closer to agreement with these car makers, and that's where we find ourselves now. Of course, the union continues to ask for a 36% wage increase over the course of a 4-year contract. All 3 automakers remain instead right around the 20% mark, so there's still a lot of daylight there, but that really isn't the only issue. Take Stellantis, for example. Union negotiators have said just some of their most important issues aren't being addressed, including the issue of job security, given the potential closing of a number of Stellantis facilities. There's also the wider question of the role of workers in the EV transition. That's one of the complicating factors here in Washington for President Biden, who has pushed that EV agenda, but also is trying to be the most pro-union president, he says, in history. He has still been on the side of the UAW. He says record contracts for automakers should mean record contracts for record profits, rather, for automakers should mean record contracts for auto workers. And yet we're still trying to figure out the contract details. And the longer this goes on, Matt, the more pain theoretically it could inflict on the economy. If we see this strike expand to all 150,000 UAW workers, for example, that could affect about a third of the auto production here in the U.S. And remember, the auto sector is about 3% of GDP.
Yeah, it's, I think, a fascinating set of negotiations here. I mean, Dodge and Chrysler don't even have really any products announced for next year. They've shown us a Banshee concept, but nothing since then. And this could amount to a real wage price spiral if it gets out of control in the other direction. Kayleigh, how worried are people in Washington about this in terms of its effect on inflation or the slowdown of the economy?
Well, they're always worried, Matt, about inflation here in Washington. That said, at least on the left side of the political spectrum, including in the White House, there is a conversation happening ongoing about how much profit corporations are raking in and how that should be translated to workers. If you are pro-union, which many Democratic lawmakers are, they would like to see the UAW workers getting more money here. There's even some Republicans who are saying that, like J.D. Vance, the senator from Ohio, where you herald from, Matt, who have said that the UAW should be using its leverage here in order to potentially disrupt the EV transition. That said, elsewhere here in Washington at the Federal Reserve, of course, they are watching this very closely. When we talk about 150,000 workers, we are talking about a very small fraction of the American workforce. So theoretically, it wouldn't necessarily expand elsewhere, but it just speaks to this dynamic where employees are still feeling like they can ask for more money, and if they get it, that could refuel inflation.
Sure, if you're at a supplier or another automaker, even if you're not a union worker, you're going to look at them and say, I want that.
Yeah.
Also, we call it the great state of Ohio, Kaylee, because 8 presidents call Ohio home.
Of course.
Thanks very much. Kaylee Lines there in Washington, D.C. Joining us now with a look at what's going on in the stock market ahead of the opening bell. Let's bring in Abigail Doolittle. Abby, what are you looking at?
Well, Matt, we are looking at a little bit of a relief pop for U.S. equity futures overall, with the S&P 500 right now up about 0.3% after a 3-day slide. Yesterday, the worst day for the S&P 500 on that hawkish Fed pause going back to March. But today you can see Amazon getting a nice boost, up 1.4%. This as they are saying that their Prime Video content will include ads starting next year. Activision Blizzard up nearly 2%. The deal with Microsoft is set to clear the final UK hurdle. And then ExxonMobil, just to broaden it out a little bit, we do have WTI crude still above $90 per barrel, up about 0.9%. And Morgan Stanley is maintaining their overweight on the shares. They've also raised their price target to $131. Not so bad. Again, a little bit of a bullish tilt for stocks this morning.
All right, Abby, thanks very much for that. Peter Cheer and Jay Pulaski are going to be rejoining us. I'm going to ask them what they think about the strike, as well as the shutdown. Time is running out on Capitol Hill.
Kevin McCarthy, on the other hand, doesn't play this right, could be subject to a sort of oust the speaker movement. And if that happens, then we have chaos. Then the shutdown could last a lot longer. And that's the nightmare scenario.
Government shutdown conversation still ahead. This is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
By 2050, half the world's population will live in areas that don't have enough water to sustain life as it is today. But the global beverage industry has proven that solving that water crisis could also help combat climate change.
On average, we can help beverage companies reduce water usage by 25%, which results in a 12% reduction in energy and a 6% reduction in greenhouse gas emissions.
If companies want to make a difference on a global scale, they should transform the way they think about water.
Shutdown could last a lot longer, and that's the nightmare scenario.
A growing risk of a U.S. government shutdown with just 9 days left to make a deal, splintering within the Republican Party. Still causing massive problems. Speaker McCarthy's defense spending bill blocked on the House floor for a third time by a pair of ultra-conservatives.
Two people flipped, so I got to figure out how to fix that.
Did you know that they were going to flip before the vote?
No, that wasn't the impression they had given.
Representative Marjorie Taylor Greene, one of the GOP dissidents, suggesting McCarthy shouldn't have been surprised by her vote.
I've told him everything that I've told everybody else. I'm completely transparent in every conversation I have. We should have been passing our appropriation bills back in August.
Bloomberg's Anne-Marie Horder joins us now for more on, is it fair to call this an absolute mess?
It is a mess, and we are looking like it's looking ever more likely that we will have a shutdown. And I think you could see the division there just from hearing Speaker McCarthy and Marjorie Taylor Greene. Marjorie Taylor Greene voted no on a rule yesterday. That rule would allow a debate on a defense bill, not even a vote for or against the bill, just the debate on the defense bill, because it took in and included Ukraine aid. This is what she said to Kayleigh Lyons yesterday. Kayleigh was up at the Hill. That is one part, Matt, of the GOP caucus. On the other hand, you have a congressman like Mr. Lawler. This is a New York congressman. He's from a Biden district, and he wants to see a vote next week on a continuing resolution. And if he doesn't see one, he says he may have a discharge position, which means he can work with Democrats, put one on the floor that would go over Speaker Kevin McCarthy's head. So this is what Kevin McCarthy is dealing with in terms of some of the individuals in his party and how far apart they are. And that gap just at this moment does not seem to be narrowing.
Does at some point McCarthy himself have to choose between being the speaker and getting absolutely nothing done or governing and getting the boot?
Well, the thing is, if he governs and gets the boot, this will be even more chaos. Then who comes next in this position? What you're seeing is because he is dealing with very, very slim majority. And actually, that majority actually got even slimmer because there is a congressman who retired recently. You have some individuals who are out because of medical reasons as well. So this is going very difficult for Kevin McCarthy. And what you see him try to do is what we saw during the debt ceiling debacle, which is try to get some leverage from the hard right, put that on the floor, and see if that works when he's dealing with Schumer or the White House. But at this moment, he's not even able to get the hard right bill of a continuing resolution on the floor. If he does work with the Democrats, that means he's likely going to face a motion to vacate.
All right, Anne-Marie, thanks very much. Anne-Marie Horder here in New York for UNGA, talking to us about the government shutdown as well, which I think it's safe to say is almost inevitable. Jay Pulaski and Peter Cheer are back with us. Peter, what's your take on the shutdown and how much it matters maybe relative to the UAW strike?
You know, for me, both are fairly back order type effects. If the shutdown lasts months or something, maybe it's a problem. If we get it in a week, I don't see a big deal. I think the auto worker strike is potentially a risk. Again, that will take time to see how it plays out. When I'm sitting here trying to look at the world, and what I want to figure out over the weekend and the coming weeks is, we're going to see some AI success stories. I really want to figure out, are companies going to be able to start demonstrating, hey, we've used AI and we've seen these great efficiencies? Because I think that would be much more important to the market than anything that's going on with either the government or right now even the auto strike. And I'm looking at the IPO market, right? We've started to see some enthusiasm for IPOs. It's been mixed results. Do we get one of those pops where all of a sudden you start seeing companies, you start seeing acquisitions, maybe like Cisco did yesterday, and really that drive the market? So in my scheme of things, that's what I'm looking for, and those other issues right now are kind of taking the back seat.
Jay, what do you think? I mean, a lot of economists have been telling me the UAW strike could be a real problem going forward, because if it goes on for a long time, that's going to mean big inflation for cars and a slowdown in GDP. If they get a serious wage hike, then everybody else is going to want that too, and that drives up the pay.
Well, I think, first of all, Matt, D.C. is a clown show, right? And it has been for a long time, and I think markets are not going to be surprised by that. As far as the UAW, I expect it to be resolved reasonably quickly. There's plenty of money to go around. Profits in car makers have been significant over the last couple of years and likely to continue to be so. Here at TPW Advisory, we're focused on 4 signposts to the road to stability. And the first is continued disinflation in the U.S. and Europe. The second is a incipient global manufacturing recovery as we shift from inventory destocking to restocking. The third is continued upward revisions of earnings. And the fourth is policy traction in China. We're very focused on the opportunity set there. As long as China starts to gain traction, which we expect to be the case over the next quarter or two, we think the global economy is going to be fine. And look, we continue to be focused on opportunities outside the U.S., particularly in emerging markets and in commodities. And I think the U.S. is going to be fine, risk assets, because earnings are going to be fine. And that's all that really matters at the end of the day.
Peter, we just got 30 seconds here, but you know, there's a list of headwinds I don't even have to go through anymore because we all know them so well. Are you as bullish the global economy?
No, definitely not. I think China, to the extent they are going to see growth, it's going to be by them selling their products into emerging markets countries. So I think that's a risk for U.S. companies that sell into emerging markets. I do think India is really interesting. I think India, I'm trying to figure out the right way to play it. I expect really good growth out of there. And the one thing I'm worried about in terms of a commodity super cycle is India getting its story correct between space, between AI, between infrastructure, between onshoring or reshoring that's going on in India. If they take off, I think we could see a 2006 to 2008 type commodity super cycle. And it seems to me that sort of inflation is the U.S. Achilles heel. So that's something in my background as a real potential headwind, not today's problem, but maybe next year's.
All right, Peter, great to get some time with you. Peter Cheer there from Academy. Jay Pulaski, always good talking to you from TPW Advisors. Coming up, the morning calls, and then later, big tech falling victim to surging bond yields. Mona Mahajan of Edward Jones joins us at the opening bell, revealing her higher for longer playbook. That conversation still ahead. This is Bloomberg.
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is the countdown to the open. I'm Matt Miller in for Jonathan Farrow. After the big drop that we saw yesterday, off 1.6% on the S&P, the first time we dropped below 1.5% for over 101 days, we're looking at futures that are bouncing ahead of the open. Let's get to the morning calls right now. First up, Wells Fargo upgrading Charter to an overweight, expecting growth to reaccelerate due to new mobile and video initiatives. Next up, Canaccord downgrading Deere to a hold, citing slowing growth for large agricultural equipment and normalizing dealer inventories. And finally, Bernstein upgrading Wayfair to a market perform, pointing to improving revenue growth and management's positive messaging on margins. Coming up, big tech set to rebound as Treasury yields fall from multi-year highs. That conversation up next, as well as the open. Mona Mahajan of Edward Jones joins us. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is the countdown to the open. I'm Matt Miller in for Jonathan Farrow. Moments away from the start of trading, we see futures up across the board after the big drop that we had in the live trade, in the cash trade yesterday, and after yields came back down a little bit, giving tech shares a little bit of room to breathe. There you hear the opening bell, and you can see it there on the New York Stock Exchange and here on the Nasdaq. Let's switch up the boards and take a look at some of the other asset classes that we pay attention to. The euro dollar, 106.48 right now. Not a lot of change there. The 10-year yield also a little changed, but still at a relatively high level, 447.63. And NYMEX crude back up above $90 a barrel after having dropped below that benchmark price yesterday. 91.13 the level for West Texas Intermediate. Now, one stock to watch at the open this morning has got to be Activision. Microsoft is closing in on its $69 billion acquisition after passing a final regulatory hurdle in the UK. Microsoft executive Brad Smith saying, quote, "We're encouraged by this positive development in the Competitions and Markets Authority's review process." Ed Ludlow is here with more on this big deal. Ed?
It's astonishing because at the beginning of the summer, anyone you would talk to would say this deal wasn't going to happen. Now, look at Activision shares, $94.10, 90 cents away from the $95 per share offer that Microsoft made. This is a $69 billion deal. The compromise that Microsoft and Activision put on the table was to sell the cloud streaming gaming rights to Ubisoft, a French independent video games studio and publisher. And from the CMA's perspective, the Competition and Markets Authority, that is good enough to maintain a competitive market to their mind. It's interesting because basically Microsoft and Activision went to regulators, the CMA being the final hurdle, saying, the cloud market is a tiny nascent part of the video games industry. Why are you so hung up on this? But it's what they wanted to see. And Sarah Cardle, the CEO of the CMA, was on our programs earlier this morning saying, this is a lesson learned. Next time, it would have been easier if you guys had just done this compromise to begin with. There is a consultation period through October 6th. But right now, based on the spread and all of the reaction to this CMA provisional decision, this deal is going through, and it's a big one for the video games industry.
Yeah, a big one people care about, Call of Duty as well. Ed, thanks very much for that. Some breaking news right now on Ford. We see the shares also popping in the pre-market. Let's get over to Abigail Doolittle with the details. Abigail?
Yeah, indeed, Matt. We do have the shares of Ford popping higher right now, up about 2.5%. The best day since early June. And this on a Reuters headline that the UAW is to announce progress made with Ford in labor talks. And of course, at 10 a.m., the UAW is expected to ramp up this very particular strike that they're doing, surgical strike that they're doing. But now we do, of course, have this headline that UAW has announced progress made with Ford in labor talks. The shares are higher, up 2.3%. We also have a sympathy trade in the shares of GM. They are also higher, so we'll be waiting for more here. But the idea, quote unquote, real progress has been made by the UAW with Ford. So it will be interesting again to see what announcements could potentially follow this, and if it also is a good sign for both GM and Stellantis. One other stock that is moving this morning, of course, Matt, is Amazon. This after the company has said that they, similar to Disney Plus and Disney ESPN and Hulu and some of those other streaming services, along with Netflix, they are going to be running ads on Prime Video in key markets starting in 2024. And of course, right now, Prime on a yearly basis costs $139. The cost to not have those streaming ads, $299 a month, which is less than Disney. I believe it's also less than Netflix. But these major streaming services, they are trying to bring ads into the service and then get people to pay extra to not have to have that. And just to return quickly, Matt, because you are a car guy, Ford right now at session highs, up 3.4%. The best day, again, I believe, since early June. And on this Reuters headline that the UAW head saying that real progress has been made. And we also have now CNBC reporting on that in addition to Reuters.
Yeah, it's interesting. Usually the UAW gets along with Ford best. The workers like that the company is essentially family owned, or, you know, in a sense, and that Bill Ford gets personally involved in those negotiations. So typically they're friendlier. On the other hand, it hasn't looked like that over the past couple of weeks. We'll continue to follow these developments very closely. Abigail, thanks very much for that. Now, a big day for Apple. The new iPhone 15 going on sale in roughly 40 countries today. Dan Ives of Wedbush writing, quote, iPhone 15 pre-orders are still tracking much stronger than we and the street originally expected, and up roughly 10 to 12% from iPhone 14 based on our analysis. Katie Greifeld is here with the latest. Katie, did you get yours yet?
I haven't gotten mine yet, and apparently online reservations are hard to come by as well. But you take a look at shares this morning, up slightly as the iPhone 15 Pro and Pro Max models go on sale in this first wave. And Matt, there's at least two big tests here. The first one, of course, is what demand will look like for the new iPhone 15, and also can Apple fulfill that demand. Now, at least on the first point, there's plenty of early signs that indicate that people definitely want to buy this new phone. You take a look at new online orders for the highest end new models, and they won't arrive for customers at least until mid-November in several countries, rather. And while reservations for in-store pickups, they actually quickly sold out. So a lot of early indications of demand, and that's good news for Apple because there is a lot riding on this. These models will represent Apple's biggest sellers through the end of 2023 and are expected to make or break Apple's holiday season. Obviously very important for the iPhone maker. It's hoping to return to growth after a streak of quarterly sales decline, Matt.
All right, we'll be watching that. I saw lines outside the Apple store on Fifth Avenue driving in this morning already. Katie, thanks very much for that. Mega cap tech stocks flirting with one of their worst weeks of a pretty good year. Surging bond yields have kept pressure on some of the sector's biggest names. Mona Mahajan at Edward Jones weighing in, writing, quote, "We expect some broadening in leadership as rates remain elevated and would look to complement growth in tech stocks with better valuation parts of the market. Cyclicals and over time, small caps may play some catch up." I'm pleased to say Mona Mahajan joins us now with more. Mona, great to have you on the program. I didn't see the word value there. Certainly not, describing that group of stocks. It's almost become a dirty word in this market because it doesn't seem to ever win out. What's the story?
Yeah, thanks, Matt. Look, I think a lot of the sectors that were mentioned there are part of the value complex. So to broaden it out to value more broadly, I think probably would also include some of the defensive parts of the market like healthcare, staples, and utilities, which tend to outperform in periods of a recession. And clearly this economy has held up too well to pile into defensive parts of the market. So we want to be really particular in what we're looking at if we do expect a broadening of market participation. And this is really for the quarters ahead as we head towards 2024. That is really an environment where we see the Fed potentially pausing and, as they've indicated, maybe pivoting lower. We see inflation continuing to moderate, and we could get a rebound in earnings growth as well. So that's a better backdrop for a balanced portfolio. Now, we wouldn't want to wholesale get out of the AI tech story. We think that's in early phases of a secular bull market as well. But we certainly think, given what's happened this year particularly, some broadening of participation, especially if we reemerge from some sort of period of economic softness, does make a lot of sense. We want to make sure portfolios are balanced, diversified, and have exposure to those cyclical and potentially small caps as well.
What are the cyclicals? I mean, do you like the automakers right now? It seems like a tricky situation.
Yeah, I think we have some headwinds ahead of us that not only with the UAW strike, of course, we have a potential government shutdown. We have oil prices that remain elevated, walls of worry that the market will have to continue to climb. But markets have looked forward in the past. They will continue to do so. So within the cyclical complex, we think industrials make a lot of sense, especially as infrastructure will continue to be built out here in the U.S. and globally. A lot of manufacturing is coming onshore across the globe. And so I think that'll be a trend that continues to play out in the next 12 to 18 months. Certainly areas like financials, which have historically been more levered to a better economy, could look to a period of better performance, but probably not till 2024, back half of 2024. And energy is the other part of the cyclical story that's already shown, better performance even in this quarter. Part of that has already played out, but I think, those three sectors and cyclicals we would continue to watch carefully. Think about consumer discretionary as well as we move forward.
Yeah, I was wondering about that. I mean, restaurants, airlines, hotels, luxury. How do you view the U.S. consumer right now as we get reports from places like, Darden, that its customers are choosing less expensive wine, although those aren't probably the same customers buying stuff from Hermes and Gucci.
Yeah, look, it's interesting. The consumer has been the backbone of this economy. They've been extremely resilient thus far. But we are entering this period. We're at the end of the summer travel season, and consumers are faced with not only higher oil prices, now an interest rate environment that may be higher for longer. And of course, we know they've worked down some of those excess savings that were given to them in the post-pandemic period. And by the way, credit card levels are elevated and lending standards are tighter as well. So this is, probably some headwinds to consumption in the consumer in probably the 1 or 2 quarters ahead. We'd expect a bit of softening, not only in the consumer, but we're seeing early signs of labor market maybe cooling as well. So areas that had really held up well, will the next move be, better or some softening? We think probably some easing is likely. And so that's something to keep in mind, especially as we think about, earnings and growth in the months ahead.
What about rates? I mean, 4.5% on the 10-year, more than 5.1% on the 2-year. I mean, really across the curve, you're getting a decent return, so that even if you don't see capital appreciation, which seems likely to me, you're still getting a nice coupon.
Yeah, Matt, you summarized it well. Look, with yields towards the highs of this cycle, In fact, of course, there is some intrigue in the shorter duration part of the market. Cash and cash-like instruments are giving an opportunity that we haven't seen really in recent history. But there is some risk there. If you're in a CD and you have to reinvest in the months ahead, you might have some reinvestment risk. You have to reinvest at a lower rate. But also you can miss out some of the interesting opportunities that are forming. And to your point, the bond space in particular, especially if we look at a little bit of a longer duration investment grade bond area, that could be really compelling. Historically, forward bond returns have been determined by where the current yield is. And current yields, as we know, are probably towards a peak. And you're not only kind of locking in these better yields for longer, but you have that chance, to your point, of price appreciation. If over time, the Fed not only pauses, they pivot lower, you really have this nice window for extending duration ahead of that move, to your point, price appreciation and locking in yields. It's a nice combination that you might be getting in the months ahead.
Mona, stick with us. Mona Mahajan there from Edward Jones. We're continuing to see breaking news come across the ticker on Ford. People familiar now telling Bloomberg News that the UAW is making meaningful progress with Ford. And of course, we're set to get an announcement from the union president at 10 a.m. on Facebook Live. And then he's set a deadline for 2 hours after that. Let's get back over to Kaylee Lyons right now. She's in Washington, D.C. and has more for us on this developing story. Kaylee?
Well, Matt, you can see it moving the market already. Ford shares now up about 2.5%. If these gains hold, could be the best day for the stock going back to June on this news of progress being made with this one particular automaker. We will, of course, look for details from Sean Fain's live streamed event that is happening just about 20 minutes from now. But remember, there's still two other automakers at play here, GM and Stellantis, and we don't have news at this point of whether or not progress is being made on that front. So when we're thinking about the ways in which this strike could expand or not, which automaker could see more pain inflicted by the union? Ford shares, though, definitely benefiting from this news. Now, we did have a separate report also just moments ago from Reuters that the UAW was going to ask President Biden or invite him to come to the picket line. And this is really interesting, Matt, because, of course, as we've talked often about, President Biden has billed himself as the most pro-union president in history. He's come out on the side of the UAW workers, even though he says no one wants a strike. But also we have to consider that next Wednesday, on the evening of the second GOP primary debate, former President Trump, is going to be counter-programming that debate by being in Detroit and addressing the UAW. So it'll be really interesting to see if we have the former president and current president, who right now are the front runners of each of their individual parties in the 2024 race, showing up at the picket line. But as for Ford in particular, right now up about 2.25%. We'll look for more details on that progress from Sean Fain just a short time from now, Matt.
All right, Kaylee Lyons there covering the developing strike story for us out of Washington, D.C., and obviously it's very closely related to the political story as well. So she's an excellent person to get updates from. Coming up, fresh economic data rolling in. We're breaking the latest U.S. PMIs after a little bit of a disappointment out of France and Europe. This is Bloomberg.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
I know one of the reasons you're here in Marrakesh and in Africa because you see the enormous potential this continent has as a source of renewable power for electrolysis, right? That's the process by which hydrogen is extracted from water. Tell us about Africa's potential.
Africa's potential is the best in the world, and it's Africa's shot now. It's Africa's turn. What will stop Africa rightfully taking its turn will be lack of progress on technology. Companies and governments around the world choose Fortescue because we are the world leaders in technology, world leaders in next era electrolyzer design, cables, solar, all the tech which is moving our world on from having to rely on dinosaur era fossil deposits of oil, coal and gas to simply today's era of machines which make machines to harness all that beautiful renewable energy and give all the mobile energy, all the fixed energy this world could ever need by many times. Those countries who resist that are denying Africa their opportunity. And I'm saying, stop it. Let's get in behind Africa.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see myself yet.
The committee left the additional rate hike this year in the dot plot. I think that may be a good thing to do as insurance to make sure that core inflation especially continues to come down. I think the risks are building that inflation could hang up at a higher level or even go higher based on the idea of a reacceleration in the U.S. economy.
That's former St. Louis Fed President Jim Bullard speaking yesterday with Mike McKee on the U.S. economy. Breaking PMIs crossing the terminal right now. Let's get over to our international economics and politics correspondent, who is actually sitting right next to me. There.
Yeah, not overseas, but we do have numbers both in the United States and overseas, and the U.S. is not Europe. We can say that. Global manufacturing on the S&P manufacturing index for the PMI, 48.9. That's up from 47.9. Still a little bit below the 50 break-even point. But services and the composite for the U.S. remain above 50. 50.2 for services, 50.1 for the composite. Those are down a tick, but they do show still continued growth in the U.S., and that is a completely different story, Matt, from what we see over in Europe. You take a look at France, Germany, the Eurozone, and the UK all reporting today those global, those S&P global PMIs. And look at all the 40s. There are no 50s there, and in Germany, rather, you see 39.8 for manufacturing. Germany, the only one of those countries at this point forecast to actually go into recession by economists surveyed by Bloomberg, but the UK very close to it, and of course the Eurozone itself is struggling with manufacturing. You look at those numbers, and it is definitely not the U.S. We'll see what the Fed thinks of these numbers and what the Fed thinks of what the Fed did, because today we get a lot of Fed speak. The blackout lifts today. Lisa Cook is speaking. Mary Daly and Susan Collins are speaking. All this coming up after 10 a.m. this morning, and Neil Kashkari later this afternoon. So we will get some idea of whether the markets are reading the Fed right and what they decided the Fed is going to do after the decision on Wednesday.
All right, Mike, thanks very much. Michael McKee there, Bloomberg Television's international politics and economics editor. Mona Mahajan is back with us. And Mona, you know, what's your take on, I guess the PMIs here are pretty much in line with expectations. The French PMIs I saw disappointing, and Europe looks like it may be contracting. How does the economy look to you?
Yeah, you know, it's interesting when you look at the dichotomy between manufacturing and services. Of course, manufacturing had been in a downturn, and now we're starting to see a bit of stabilization, even a tick higher. And services, which had been driving, you know, the U.S. economy, looks like it's heading towards a peak. And so this idea of rolling downturns, or as some call rolling recession, could still be in play here. You know, parts of the economy that had originally really kind of gotten hit hard by the Fed rate hikes are starting to see signs of stabilization. You can maybe even put housing in that category, and services, which, you know, had kind of chugged along, may now start to stall a bit as we're heading towards these peak rates that finally, you know, may catch up with that lag impact that we've all been talking about. And so we do think that the U.S. economy could soften, but probably not, you know, heading towards any sort of technical recession, but a period of below trend growth. And even in the Fed projections, you know, the 1.5% for 2024 could imply a softer first half followed by a rebound in the back half of the year. And I think that to us seems like a credible backdrop.
In terms of next year, you know, so many people have been saying we're going to see double-digit earnings growth come back again. I guess you have to be in the soft landing camp to believe that. But if we do get sweet economic growth in the U.S., why do you think the Fed would cut rates twice? What's the catalyst?
Yeah, it's a great question. And, you know, look, I think with rates here, even at 5.25% to 5.5%, still highly restrictive. And if you think about inflation perhaps continuing to moderate, you know, even in line with their own projections, that brings the real rate, you know, the nominal rate minus inflation, even higher. Even if the Fed just, you know, keeps steady at this pace on pause, real rates, which do impact the economy and do add a bit of tightening, continue to move higher. Now, if they do believe that a neutral rate is closer to 2.5% to 3%, and if inflation continues to moderate, do they need to stay at such a restrictive level for an elevated period of time? And so I think over time, the way they would probably communicate it is they're going to start normalizing rates gradually back towards a neutral level. And so that could be where you get the signal of 1 to 2 rate cuts next year. We think that is a credible scenario. If the economy softens more than they expect, you know, the original scenario of 3 to 4 cuts may be back on the table as well. But for now, I think a normalization out of this highly restrictive territory is probably the path of, you know, most credible for now.
All right, Mona, thanks very much for joining us. Mona Mahajan there from Edward Jones. Let's get some sector price action this morning. For that, we go to Bloomberg's Abigail Doolittle.
Yeah, Matt, very quickly, we are looking at a rebound rally for the S&P 500. So we have more sectors higher than not, led by energy. Interestingly enough, we have some of the rate-sensitive sectors on bottom, such as utilities and real estate and healthcare. Even though rates are lower, those dividends should look better. That's not the case. On the week, though, let's take a look at the week. The S&P 500 right now heading to a decline of 2.5%, the worst week since early March. Here are the two best sectors: defense, so that's risk off, and then the two worst sectors, real estate and consumer discretionary. Rough week for stocks, third week down for the S&P 500 in a row, Matt.
All right, Abigail Doolittle, thanks very much. Coming up, the market-moving events you need to be watching. That's next in our trading diary. This is Bloomberg.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, you know, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
This is Bloomberg.
This is Bloomberg's The Open. I'm Matt Miller in for John Farrow. Time now for the Trading Diary, what you need to be watching through the next week. UAW President Shawn Fain making an announcement on Facebook Live, this coming amid fresh reports of meaningful progress just in the last 30 minutes in the UAW's negotiations with Ford. That announcement on Facebook Live at the top of the hour will bring you all the headlines. Plus, more Fed speak from Mary Daly and Neil Kashkari. That's at 1 p.m. New York time this afternoon. We get U.S. GDP next Thursday, plus more Fed speak from Goolsbee, Barkin, and Chair Powell. And finally, the government shutdown deadline coming at midnight on September 30th. This is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
How do you compare the pleasure of being Secretary of State, Senator, First Lady with being a grandmother?
Well, actually, there are similarities. Negotiating with 3-year-olds is about as hard as anything I did as Secretary of State.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Friday morning from the Bloomberg Interactive Brokers studio in New York City. It is Friday. We made it. Coming up, we're going to take a simulcast of UAW's Sean Faines. He has some Facebook Live comments coming up in just moments. And when he does that, we will bring that to you. We're going to check in with Ed Curry, radio reporter for Bloomberg News. He's in Detroit to kind of get the latest there. Who's darkening our doors?
We have Anne-Marie Horder here.
Wow, that is big.
She is here in New York, luckily for us, to cover UNGA. But you've also got the government shutdown virtually guaranteed, and the UAW strike that's pulling in President Biden, or at least attempting to.
I'll tell you what, Anne-Marie did nothing to help the traffic this week. I mean, it was as bad as ever. Crosstown, impossible.
Today
Today
was better.
the public regarding the exchange's licensing and other operational aspects. The crackdown reportedly follows over 1,400 complaints made to local authorities and suspected involvement of assets worth approximately 1 billion Hong Kong dollars, or about 128 million US dollars. Meanwhile, the exchange faces a liquidity crisis with halted operations and skyrocketed withdrawal fees, which JPEX attributes to, quote, malicious, end quote, actions by third-party market makers. Of course, it's entirely possible that these were just investors making a better bet than the exchange could or wanted to handle. Japan Securities and Futures Commission, or SFC, had previously flagged JPEX for allegedly falsely claiming it had a valid license. The exchange, asserting its commitment to continue operations, is actively negotiating with market makers to resolve the cash flow shortage. In the face of plummeting Bitcoin NFT sales and a broader asset class downturn, the creator of the Bitcoin Ordinals protocol, Casey Rodamore, is advocating for a revamp of the current inscription numbering system that lets users draw or inscribe images and other data directly into the Bitcoin blockchain. In a post on the GitHub repository that houses the Ordinals codebase, the software engineer argued that the existing method has led to complex code and hindered progress. Initially, the numbering was designed to remain stable, meaning inscriptions would retain their original numbers forever. However, maintaining this stability has proven to be a significant challenge, especially with alterations to the inscription protocol. The current system assigns negative numbers to unrecognized inscriptions, creating what Rodamore calls, quote, cursed, end quote, inscriptions that fail to indicate the order of creation and adding complexity and bugs to the system. Rodamore proposes integrating these cursed numbers into the main sequence and eliminating their use in URLs. This adjustment, he notes, would result in what he says are minimal changes, with new numbers differing by about 1% from the old ones. When Ordinals first launched this January, they were controversial for potentially bogging down Bitcoin transaction volumes by creating traffic that some viewed as being not fundamental to Bitcoin's core value proposition, while others saw them as a crucial step to remaining competitive against the likes of Ethereum, which started to popularize NFTs as far back as 2015. Those concerns have waned of late, with Ordinals volume down 97% between May and August, according to a DApp Radar report. As always, there's plenty going on in DeFi and DAOs. Here's a quick roundup. Over 70% of ApeCoin DAO members backed proposal AIP 297, co-authored by Animoco Brand's chairman Yat Su, to create a sister DAO and NFT community treasury for influential NFT acquisitions. Layer 1 blockchain network Kanto said it plans to transition to an Ethereum Layer 2 utilizing the Polygon Chain Development Kit for a network emphasizing the integration of real-world assets. The creators of Layer 2 network Optimism announced a $26 million airdrop distributing 19.4 million OP tokens to 31,870 addresses as part of their engagement and reward strategy. After much deliberation, the founder of F2 Pool, a crypto mining operating business, decided to refund 19.8 Bitcoin to blockchain infrastructure firm Paxos after the firm inadvertently paid a whopping $520,000 fee on a relatively tiny $2,000 transaction. Mark Cuban, the American billionaire investor, reportedly lost $870,000 in a DeFi-related scam. Looking for something more fun? Genesis is rebranding. You may wonder why. To what? Take a closer listen to stand-up comedian Ginny Hogan's take on the whole matter.
Huge news. Genesis is changing its name to Exodus, or at least its mission. Last week, the company announced its plan to sunset, a term definitely created by a person who has never looked at a sunset, all its trading services worldwide. The sun comes back a few hours later. The spokesperson said that this decision was made voluntarily, which is very good because I cannot support non-consensual sunsets. Genesis filed Chapter 11 bankruptcy earlier this year, but at the time, they thought that their parent company, DCG, would bail them out. But no, Daddy's out of cash too. This is literally the plot of Schitt's Creek. Good news is that Genesis has assured users that they'll be made nearly whole. The bad news is that they haven't specified what that means. Genesis owes its creditors nearly $3.5 billion. Some, such as the Winklevoss twins of Gemini, say that that is wholly insufficient. Okay, Winklevi, here's the rock. Use your strong rowing arms to squeeze some water out of it. For any Genesis users out there, you have until Wednesday to finish up your trades. 48 hours is an eternity in crypto. There's still plenty of time to lose thousands of dollars.
And that's all for now. Thanks so much for joining us today. Unchained knows it's very hard to keep up with the latest news in the crypto
I think gives a little bit of clarity to the environment that we're in. The vast majority of our clients and our business owners are still optimistic. They're still doing transactions. Builders are still building, developers are still developing. There's still a lot of opportunity in the market. Everybody still has a job. Everybody's comfortable that they're going to keep their job or that they can move to a different job. And I think that level of optimism continues as we move forward. There is now a cost of money that has to be imputed in every transaction. And I heard a little bit about that before. And I think that's really the important part. People can still do things. You just have to include what is going to be the cost of the transaction to do it.
Okay,
Money,
so
like
are people still taking out mortgages?
Yes, people are still taking out mortgages despite what was said before. I think people are still buying homes. We are woefully underbuilt in this country and certainly in this market. We're some 1.5 million homes short. And so every builder that we represent, when they put product on the market today, it's selling. And so I'm very optimistic about that. Rentals are still staying strong. Every project that we've gotten behind relative to financing in the multifamily space is renting up as soon as it's completed.
Wow.
So a lot of good indications out there.
All right, the devil's in the details, and sometimes it's like nanometers that gives you an idea of maybe a new trend being built. So, Frank, are you seeing, though, any signs of softness, stress, concerns, defaults, maybe, terms being renegotiated? Give us an idea, because again, the devil's going to be in those small, minute details for us to kind of figure out if we start to see a change.
Look, we've certainly seen that our group of clients are being much more thoughtful about various projects, transactions, or business opportunities because of that added cost of financing. And so the volume of things is certainly down. I can definitely report to you that. And so we're seeing that not just here at Connect One, but we're seeing that across the industry. Lending, for the most part, has slowed down quite a bit, and that will make its way through the economy, which is something which the Fed is actually engineered to happen. So we are seeing a level of people thinking about things in a very different way, adding that cost of funding, thinking about whether or not certain things make sense. And there are things that made sense in a 0 interest rate environment or a 2% interest rate environment that don't make sense today.
Like
and
what?
So those things are off the table.
Like what?
Well, any transaction that you would look at, even a builder who's going to develop a project, today the cost of money requires that project to have a different outcome, a different sales price, a different rental pro forma, and certain projects don't pencil out. Others do, and the ones that do, there's money available for them, and they're continuing to move ahead and do those things.
Frank, give us an update on deposits. I mean, we're in an environment, I've said it, a dozen times today, where money market funds are yielding over 5%. You've got some high interest savings accounts at some upstart banks that are yielding close to 5%. I think Citi has some sort of promo out, 5.5% for 6 months if you put $100 grand over there or something. It's like, what are deposits looking like for you guys right now?
So again, we're mostly a commercial institution, and so we cater to the vast majority of businesses and small businesses, and we are seeing deposits tightening up a bit. People have a little bit less liquidity on their balance sheets today, and that's what's causing the competition. Again, engineered by the Fed. All the qualitative easing that was brought to market in 2020 is now being let out of the economy through qualitative tightening. And so there's less deposits to go around. Deposits are the fuel for banks to make loans. And so there's heightened competition amongst banks, amongst non-banks, money market funds, all the various actors that you mentioned before. That's driving up that cost to banks and a benefit to individuals who are either opening accounts or investing money. And that's having an impact on the economy as well. So yes, we could get into an economics lesson here where M2 declined for the first time a few months ago. It has flattened out recently. I do believe the Fed is going to take their foot off the accelerator pedal there a little bit and allow some additional liquidity in the system so they don't break anything. And so we do have a soft landing. But I do believe that competition for deposits which I think is the question you asked, is going to continue for the foreseeable future.
Hey, Frank, remind us, is it 60% of your portfolio is commercial? I know you said most you're really commercial. Is it about 60%?
Yeah, about 60% is commercial, small businesses, all different types of businesses in and around the New York Metro.
So I am curious, how much of that portfolio, those portfolio of loans, is coming due anytime soon and is going to have to re-up potentially at higher rates? And are you seeing any strain or stresses in that portfolio?
Yeah, it's a fairly small amount that come due every quarter or even on an annual basis. We have a fair amount of fixed loans. We also have loans that reprice, obviously on a variable rate basis. With the underwriting that we've done here at Connect One Bank, we've always included an interest rate shock, and so the vast majority of the loans, as they're coming due, are well within those parameters relative to.
So no calls from small businesses saying, "Hey, listen, Frank," or to your team and saying, "We're having a little bit of a tough time. We need some help here. We've been banking with you for years. What are you going to do for us?"
Well, I will tell you that everyone is making the call.
Okay.
But the question is, are they really struggling or not? We're seeing, at the same time that we're seeing interest rates go up, we've also seen inflation push up the pricing of everything. So if we look at restaurant receipts, they're up. Maybe not because of more people seated there, but we're seeing that the average price per meal has gone up. If we look at rent roll incomes, they're up because rents have gone up. So there has been a move up in pricing for everything. And I think that's important for people to keep in mind. It's not just the interest rate component that has driven up the price of something. Revenue streams have also gone up.
Yeah, you talk to landlords and they're saying the price of insurance has shot up so much that they've got to raise the rent in a commensurate way.
And they are raising the rents, right? We're seeing rents across the New York metro market are up somewhere in the 30% range over the last 2.5 to 3 years.
Frank, we only got 30 seconds left. You have a branch in West Palm Beach and you have branches throughout New York and New Jersey. Where's the economy strongest right now based on your branches?
I still say the New York metro market. Anyone who tries to discount that market, don't bet against New York. Florida's doing really well for us at Connect One, but don't bet against the New York market.
Got a word to describe the economy right now? And just got 10 seconds.
I still think it's robust.
Robust.
All right. There it
is. We were looking forward to talking with you. It's like the perfect guest the day after the Fed. Frank Sorrentino, be well, founder and CEO of Connect One Bank on Zoom in New York City. This is Bloomberg.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, "Alexa, play Bloomberg 1130.
All right, so the rollout of the latest COVID vaccines, they are underway. Beginning, I believe, last Friday, you got Pfizer, Moderna, recommended for those 6 months and older. So we wanted to really kind of I know people who are going out and getting them, but we wanted to get some clarification for everybody about the latest strain in the vaccines and kind of what we should be doing, Tim.
Very pleased to have with us Dr. William Moss, professor of epidemiology at the Johns Hopkins Bloomberg School of Public Health. It is supported by Michael R. Bloomberg, founder of Bloomberg LP and at Bloomberg Philanthropies. He's also executive director of the International Vaccine Access Center. Dr. Moss joins us on Zoom from Baltimore. Good to have you with us. I was surprised last week to see the news from the vaccine makers saying that they expect 24% uptake for this vaccine, the COVID one at least, which is actually higher than it was in previous boosters. What do you make of that number?
Yes, thanks, Tim, for having me. I mean, it's disappointing, but probably realistic. We know that of individuals who received the primary series, only 17% overall received the bivalent booster. That proportion was much higher in the highest risk group, which is a good thing, in those older than 65 years of age, but was still only about 43%. Unfortunately, I think people have gotten tired. There's a lot of misinformation about the COVID-19 vaccines. And so I think that probably is a realistic expectation. I hope we do better than that.
Do people who are not in high-risk groups actually need to get vaccinated against COVID-19?
Yes, it's an important question to ask, and I think there are three reasons why people would want to get these updated COVID-19 vaccines. You know, the first is to prevent illness in themselves. And we know that within the months after vaccination, when antibody levels are highest, people are really protected against getting infection, or if they do get infected, get a very mild disease. We know that that protection against severe disease, particularly hospitalization and death, lasts much longer, months, even perhaps a year or longer. So the first reason is to get protected against disease. And even in individuals who are younger and healthy, it can be very disrupting to have a severe, an illness that puts you in bed for several days, you miss work, you miss school. The second reason is that there's increasing evidence that the vaccines can prevent long COVID. And so even individuals who have mild infection can go on to get long COVID, which is a complex disease with multiple different signs and symptoms. The third reason is to protect those around you from getting infection or getting severe disease, particularly those who are most vulnerable, and also infants younger than 6 months of age who aren't eligible for vaccination.
So, Dr. Moss, is it a yes, yes, and yes, go get it, essentially?
I think so. I can understand, and there is some controversy about this, particularly, let's say children 6 years to 17 years of age, healthy, and particularly if they've had the primary vaccination series, or if they've had COVID before, they're going to have immunity. They're at very low risk of severe disease. But I think, what this updated COVID vaccine does is that it targets the Omicron variants that have been circulating recently. We know there's cross-reactivity and cross-protection from laboratory work against the current circulating strains. So I would say it is a yes, yes, and yes, but I can understand why people are asking questions, particularly young who are healthy.
All right. Is there a certain group that you should say, absolutely yes, you shouldn't even hesitate?
Yes, for sure. Older adults. Now, where you draw that line is somewhat arbitrary, but people are going with 65 years and older. They're going to be at highest risk of severe disease, hospitalization, and death. Even if they've had a prior vaccination, they're at higher risk. Particularly those older than 75 years of age, and obviously those with underlying medical conditions that place them at high risk, particularly those who are immunosuppressed for various reasons.
What about kids? Should kids get the vaccine? I mean, I got to tell you, before the vaccine was available, gosh, my son was 3, so he wasn't able to get it. He ended up getting it last September, the vaccine. But before he got the vaccine, he got COVID. When my whole family got COVID, he basically had a fever for a half hour and then was totally fine after that.
Yes, so obviously the CDC recommended these updated COVID vaccines for children 6 months of age and older. It will provide additional protection. Again, as we were saying, they're young children who are otherwise healthy, who've been received the primary series before. They're definitely at lower risk. So, we want to prioritize those who are at higher risk, but I think everyone can potentially benefit. We have seen children hospitalized. I've seen children hospitalized, who otherwise well. It's rarer. The risk, the probability of that is much smaller. There's no doubt about that. But there is a risk nevertheless, and these updated COVID vaccines can provide protection.
What's more important if you could only get one of these vaccines for a kid, the flu vaccine or the COVID vaccine?
Yeah, that's an interesting question, and it's hard to predict a little bit what the epidemiology is going to be in this coming season. The risk of long COVID, I think, is an important one. Also, children have had before with COVID-19 multi-inflammatory syndrome that can also be quite debilitating. So, in my mind, some of the adverse events or impact of the disease may be worse with COVID, but that's a hard trade-off, Chris.
Well, having said that, so then what about flu, COVID, RSV vaccine for kids? What do you choose?
Yeah, so the RSV vaccines that were just recently authorized and recommended are really for adults older than 60 years of age. So they're the ones who are going to be eligible for the two new RSV vaccines. That decision, the way it's kind of written by the CDC, is that it should be done in consultation with the physician, where there's a discussion about the risk, the benefits and or pros and cons of that. So for children, it will be a decision of COVID and an influenza vaccine. And I think it's quite easy when a person goes to get one vaccine to get both. All experts recommend that they could be given simultaneously the COVID and the influenza vaccines. So I would recommend that everyone get both.
I think my husband might have done the trifecta. I'm not quite sure.
Good for him. He should get like a sticker.
You can.
Can you do it? And is it okay to do it all in one shot? No pun intended.
Yeah, I think we don't really. There's not a lot of evidence of administering the new RSV vaccines with other vaccines, and particularly with the COVID vaccine and influenza. I don't see any theoretical reason why you couldn't do it, but I know some experts are saying to space them out. And one way to kind of think about it is, what are the infections that we're seeing now? What are the infections that are likely to, come sooner? We are seeing RSV cases now, not as much influenza, so maybe get the RSV earlier. But we want people to get the COVID vaccine and the influenza vaccines probably by mid-October at latest.
All right, are you marking my calendar?
I emailed the doctor yesterday to ask about the kids. I was like, when do we go in to get the flu vaccine? Is it too early to do that? And he wrote back, no, it's not too early. Anytime before October, especially with our youngest, who's just over 6 months. She's now eligible for flu, but she has to get a flu vaccine booster after 4 weeks. So you have to spread it apart by 4 weeks.
Well, Dr. Moss, you really gave us some things to think about and some clarification, So appreciate it. Dr. Bill Moss, he's professor of epidemiology at Johns Hopkins Bloomberg School of Public Health, of course, supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. He's also, Dr. Moss that is, executive director of the International Vaccine Access Center. So man, he's like the guru.
You know what's good is when you take your kids to the pediatrician, sometimes you can get a flu shot there too.
Like,
they'll give you the kids. They have them. I do it. Yeah.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
What's really been interesting this week is, we've been talking about it. The UN General Assembly has been in session this week alongside New York Climate Week, which means we've had some really cool people hanging out with us, catching up with companies and institutions that are working on the world's most significant issues, Tim.
Yeah, one of those people is Tara Nathan, founder and leader of MasterCard Community Pass. It's a digital platform that enables the delivery of what it calls critical services to remote, frequently offline communities. She joined us on Zoom in New York City. Good to have you with us this afternoon.
Thank you for having me.
Okay, so explain what exactly you guys are doing at MasterCard with Community Pass, who it's reaching, and how you choose those locations.
Sure. So, around the globe in many communities across Africa, across India, Southeast Asia, and even frankly in Latin America, in our own backyard, there are billions of people who live in communities that are completely offline. At best, in the best of circumstances, they'll have intermittent mobile connectivity, often no power at all. And what that means is that these are communities that, frankly, are precluded from getting access to basic services that you and I take for granted. Things like access to credit, things like the ability to make a digital transaction, the ability to purchase something online, right? And so billions of people around the globe lack, the capability to do this. And so Community Pass seeks to solve for this, provides the digital infrastructure in these communities to reach people where they're at.
It's interesting, Tara, and you head to your website and you guys remind us that there's 1.7 billion people in the world that do not have a bank account, something we all take for granted, right? But, most people, or a lot of people, do not. And then you've got almost half of the world today struggling to meet their basic needs, whether it's food, education, basic healthcare. It's something that Tim and I, we look for guests to talk about, what's going on in the broader world, the developing world, because it's very different certainly to what we experience here in New York City, although there are people who are struggling here also in major cities, certainly in developed world as well. But tell us about how long you guys have been around and the impact you have had.
Sure. Well, actually, I'll just build on the point that you make. I mean, we talk about, you're right, financial inclusion and sort of the billions that lack access to something like a bank account. I think it would be maybe a surprise to some of your listeners that there are billions. There's over 1 billion people on this globe who lack access to something as fundamental as an identity. So imagine what that means. It means you and I have multiple identities in our wallets, right? We've got a school ID, a work ID, you've got a bank ID, you've got several credit cards. Hopefully they're all MasterCards. You've got several, you've got all kinds of identification. There are over 1 billion people around the globe who lack something as simple as the ability to say, my name is Tara Nathan, I live at this street, and this is what I'm entitled to. And if you want to think about a digital identity, that number can be north of 3.4, 3.5 billion people, right? So when you think about where we look to focus our efforts, it's really in those communities. It's the communities where there is no access to a foundational identity, a digital identity, and where the communities predominantly are transacting in offline communities. These are communities typically where people are farmers, smallholder farmers. So they maybe have a hectare or 2 hectares of land, right?
Wasn't we don't have a ton of time, so I just want to get a couple more questions in, Tara. But I'm wondering about mobile phones and technology, and we've talked a lot this week about leapfrogging technology, because you can go to places now with satellite technology, with mobile phone technology, and you can have your bank on your mobile phone. So weren't mobile phones supposed to fix this? And doesn't and even
Bitcoin is often touted as
right,
a
and
hedge
we've been
against
talking
inflation.
about this for years.
Yeah.
This idea, like right, like the
and a lot of phone
organizations
companies,
that cover it,
are increasingly,
value,
you have places in Africa where phone companies are doing banking.
Which means that it cannot be inflated.
No, you're spot on, and there's I think when you look at mobile banking and you look at mobile phones, they've done a great job, I think, at leapfrogging and giving many communities access to banking services, et cetera. And yet still there are billions that I talk about who are still left, disconnected and without access to the most fundamental service, like an access to a credit or a bank account or health services, education, markets, et cetera.
I guess we would love to get to is what is it? Are we making progress? Tell us about what you guys have been doing and maybe getting people so that they do have the identity, they can be part of this system. And I'm curious about where it's working, or is it a lot of women? I remember with microloans doing tons of stories 20, 25 years ago about, a small amount of money would be given to a woman because it made a difference in a family's life, if you will. So just a little bit about kind of the progress you have made and what it tells you.
We're making great progress, I'd say. Look, we started out less than, I'd say, 3 to 4 years ago. We're already we've crossed 3.8 million. We're coming on 4 million users on the platform. And when I say 4 million users, what I'm talking about is, again, a smallholder farmer. Talk about what the benefit is. Somebody who earns $1 or $2 a day. That's the person we're trying to service here. And what we're doing is we're getting her access. In many markets, the majority of these farmers are women. And we're giving her access to $5 of credit because she's now connected digitally to a bank. We're giving her $5 of credit so she can purchase seeds to plant them, to purchase fertilizer, to purchase pesticides, so that she can increase her productivity of her land, which is very important, sort of in the climate and the sustainability conversations we're having now in UNGA. And we're doubling her income. And I think that's the impact that we're trying to do. We're trying to look at how can digital technology make that smallholder farmer get paid more and faster so that she can expand and increase her sort of economic outlook.
I hear what you're doing, and the sort of like crypto skeptic and comes out in me.
I knew there's going to be a crypto element.
I mean, because the crypto people say, hey, blockchain fixes all this.
Yeah.
Are you guys leveraging blockchain tech at all?
And just got about 25 seconds.
Okay. Look, the technology is not the hard part here, right? So whether you talk about crypto or blockchain or whatever, what we're really doing, the hard part of what we're doing is building the ecosystem that serves this farmer. And that is crowding in the buyers and the input manufacturers and the bankers and the ag techs and the health techs. That's the difficult work that we're doing. So we're out in about 6 markets now around the globe, like I said, crossing 4 million users.
Wow.
And we're crowding in all these actors to service this smallholder farmer.
Well, Tara, look forward to hearing more updates in the future and appreciate time. And I know it is a busy week for you all. Tara Nathan, she's founder and leader of MasterCard Community Pass, joining us on Zoom in New York City. This is Bloomberg. So do you think the Fed's dreaming a little bit when it comes to a soft landing? They're definitely
It's not their base case.
No. But are they drinking a little bit of the Kool-Aid?
Look, they only have so much that's in their control.
I guess so.
There's a lot happening right now.
Former U.S. Treasury Secretary Larry Summers telling the host of Bloomberg TV's Wall Street Week, David Weston, that the Fed has got the memo and caught the soft landing bug.
Yeah, and that the U.S. central bank policymakers are too optimistic with their latest set of economic projections and are at risk of being surprised by both faster inflation and weaker growth than they anticipate.
Which is why this story about the Fed's dream of a soft landing facing a triple threat definitely caught our attention. We talked about it earlier with our TV colleagues in our simulcast. It is a most read story in the Bloomberg. It's in the new issue of Business Week, now out on newsstands, online at Bloomberg.com/BusinessWeek on the Bloomberg. So let's get to it. Bloomberg News global economy reporter Enda Curran with us on Zoom in our Washington, D.C. bureau, and the editor of Bloomberg Business Week, Joel Weber, here in our Bloomberg Interactive Broker studio. The gremlins are out in full force. I'm just going to tell you, Joel.
Yeah,
warning.
I could take a little bit more Aerosmith, though. Like that was a good start.
That was
a good start. Yeah. So yeah, look, this was a really important week, and this soft landing that the Fed has wanted to pull off, like it looked for a moment like it might happen. Where does it stand, Inda?
Yeah, so look, things have been a bit giddy in DC for the past few weeks, right? The data has been very good. The economy is in much better shape than anyone thought. But now there's a kind of a feeling, just when you thought it was safe, we have this unprecedented auto strike in Michigan, which really has significant potential for disruption. Potentially have the government going to shut down. That's broadly expected in a few weeks. And of course, you have students now repaying those loans that had been kind of on hold for the last several years due to the pandemic. That's going to hit their consumer income. So this kind of this triple threat has suddenly come out of nowhere. It was, just when you thought it was safe that the US had pulled off its unlikely soft landing, we've got these potentially serious headwinds now. And it's causing some people maybe to pause a little bit on some of the, as I say, some of those giddiest expectations that were going around.
Okay, so which of those 3 threats is potentially the most serious for the Fed's ability to pull this off?
It's got to be the car strike. So if that goes full pedal to the floor, so to speak, you're talking about obviously you're potentially talking about a major hit to unemployment. You could even see the monthly payrolls number turn negative on the one hand. On the other hand, it would obviously really complicate the supply chain story. Just when car prices, at least new car prices and used car prices, were coming off the boil a bit, obviously it will have potentially inflationary impact there. And so much so, in fact, that if we do have a full-bore auto strike, you could be talking about a negative fourth quarter for growth for the economy. So the auto strike is front and center. And then, of course, you have the government strike. People take different views on how that might play out, but it would have certainly a near-term impact. And then, of course, there's a student loan repayment, which obviously impacts people's the disposable income they have left to spend.
And I have to say that one of the numbers that stood out in your story is, to remind everybody that there's about 1,500 striking UAW workers right now. But if it goes to the entire UAW, it's 150,000 members. That's significant. And then, as you say, the trickle down into supply chain problems. People can't get cars. So what are economists, how are they kind of strategizing around the potential impact of this all?
They're gaming it out. I mean, a lot will depend on how these scenarios play out, right? As we say, maybe the union strike remains somewhat targeted, so to speak. Maybe they reach a deal in the near term and the economic damage is limited. But the longer it goes on and the broader that strike gets, then more material that hit will be to the economy. No question about it. It's a kind of similar story for the government shutdown. People say, oh, look, a shutdown for a few days won't have that much of an impact. But given how polarized things are in Washington, if it remains shut down for quite a while, starts to impact flow of economic data, starts to impact consumer and business sentiment, that will have an impact as well. And by the way, the other point that we flicked at is don't forget what's happening with oil prices at the moment as well. Oil price heading back towards $100 a barrel. Some talk it could go even higher than that. That's inflationary on the one hand, but of course, on the other hand, it's a tax on consumers as well. So that's going to be a clear factor. So as I say, just when you thought it was safe, that the US had pulled off this very unlikely soft landing, suddenly there's quite a few headwinds on the horizon heading into the end of the year.
Okay, so if we've got this many headwinds, how likely is a soft landing? And what do we call it?
You haven't even mentioned all the headwinds either.
Yeah.
See how high Joel's voice went?
You like that?
I did.
I think, look, the odds are, for now, right here and now, the odds are still on for, if not a soft landing, then a no landing, right? Because the US economy is in great shape, and obviously nobody's advocating a recession, and nobody wants to see significant job losses. And so far, the Fed have managed to get inflation well off the ball without doing that. But there's a view now that they're going into the really hard mile. Things get much more complicated from here. Like, for example, do they choose to raise interest rates again? And how will that flow down to people who live, month by month in credit cards? How will it flow down to small businesses who have a lot of variable rate loans, for example? The household sector on fixed rate loans aren't overly impacted, but there is a part of the business and consumer world that will be getting hurt. So we're getting into the complicated part of this now. Raising rates when inflation was running away, it's kind of a no-brainer, but it gets a lot trickier from here.
What about the restart end of student loan payments next month?
It's going to hurt. It's definitely going to hurt. I mean, there's a view that perhaps that will be quite staggered. Not everyone who has a student loan will start to pay it immediately. It'll be sort of grandfathered over time, so to speak. But economists will say to you that's taking a lump out of people's pockets right at a time when everything else is already expensive with the inflation story, with the interest rate story. So it's going to hurt consumption.
Well, sorry. Is there also though the view that if people are spending more money paying back these loans, then they're not spending as much money on services and goods. So actually, it's not inflationary?
Oh, sure. I mean, for the student loan repayment, you're talking about like to hit the consumption, to hit the growth, because you just have less money in your pocket if you're paying back a loan. I mean, our economist, Anna Wong here, makes a point that if it wasn't for the moratorium on the student loan repayments, all of the rate hikes since 2022 would already be having a much bigger pinch on that part of the economy.
Yeah.
Okay, so
Yes.
Okay, wait. So how does Powell feel about all of this?
They seem to feel pretty. Look,
does he have feelings?
He's listening.
He's listening.
I think he's a sentient being. Look, you heard yesterday. I mean, he made the point yesterday. He was maybe a little bit prickly when he was getting questioned about the whole soft landing story, but he made it clear that it's their objective, right? He didn't want to send any viral headlines yesterday about the Fed doesn't want a soft landing. He wants to do everything he can, and that's why they're going to be very careful from here, as we dubbed him in our top live blog yesterday, Mr. Careful. He knows it's going to get more complicated from here, and he knows he has a chance of pulling off a very unlikely soft landing, and that's why the Fed are being careful. But if I could just say one point, our economist Anna Wong ran the numbers, and she noted that since the 1980s, that every time there's been consensus for the US to pull off a soft landing, it's been followed by a recession. So that's the down part of this.
It's like
womp womp
womp womp womp.
Have a great evening, everybody.
we still got 6 minutes for Enda to cheer us up.
Well, don't you feel like as soon as everybody's on board with, okay, we've got a soft landing, and same thing with
bad news.
Yeah, exactly. Like as soon as everybody jumps all on board. So, it's interesting. Jim Bullard talked with our Mike McKee, and he thinks rates need to rise further because he's concerned about strong growth. And I keep wondering, is there though then the chance, listening to what you're saying and about these, this trifecta of risks, and that ultimately the Fed does overdo it and we get a hard landing?
So they're still in the territory where they feel they have to push borrowing costs higher, right? Because there was a little bit of a scare on the most recent inflation data going the wrong direction. There's a feeling among economists that what happens if we do get a relapse of the inflation story, that it does rebound. So the Fed are not declaring mission accomplished, and even if they don't hike rates again, what they are saying is they're certainly not going to be cutting rates anytime soon, right? If you look at the forecast that they put out yesterday, in fact, they're going to be keeping rates up towards in the high fours, at least for for the next several years anyway. So, yeah, like I keep saying from the beginning, it's going to get a lot more complicated from here now, because if you have a situation where the growth is slowing but inflation's still sticky and the Fed can't bring down interest rates, that's going to make a soft landing all the harder.
Can I ask you though, could it be below trend growth and then it kind of doesn't feel so great? So, maybe to technically get this recession.
Yeah, I mean, people talk about rolling recessions. I mean, Ed Yardeni up in Boston, who coined the bond vigilante term, he's talking about some parts of the economy are already in recession. It just doesn't show up in the aggregate data, right? So maybe parts of the manufacturing sector, for example. But on the other hand, though, you see retail analysts saying the holiday shopping season is still going to be very strong. They're not seeing any sign of a pullback from consumers. So it is a good news story for the US right now. To be very clear on that, it's remarkable that it's gotten this far, despite all the expectations and despite what the Fed have done, raising interest rates by over 5 percentage points. That's unprecedented in just over a year-long period, and things have held up very well. And so it's a good news story. I'm just here.
Well, it
with
was until you dropped that little zinger about the 1980. So when are we gonna know?
What, the next few months are going to be important.
AKA, when's your next draft due?
Chill. He just finished this one.
Whoa.
I do seem to be a kind of an omen of doom since I arrived in the US, by the way, with several of my pieces. But no, I think over the next 6 months we're going to get a clearer picture on how things are going, because you've got all these near-term headwinds. We'll see how that works out. We'll see where the inflation story goes. We'll see if interest rates have to go up again. You turn into the new year then. Where's oil gone? How's the global economy going? I think if the early months of next year will probably decide a soft landing story.
Okay, and there's still some stuff that could go right though. Maybe the auto strike gets averted. The worst of it. Yep. Maybe. It's only in its first week, Joel. Things could get worse tomorrow, but they could get better before, than in the next few weeks.
Government doesn't shut down?
Maybe the government doesn't shut down.
They actually get along and figure it out?
Yeah, I know. Now that I'm saying this out loud, I'm like, okay,
Take
there's
off
no way
those
this
colored
stuff is going to
glasses.
happen.
Stop it.
But what's the flip side of this argument that you make, Enda?
No, all of that could be true, right? And
little tiny could.
So you're saying there's a chance.
He's not buying it.
Yeah, but you know what? One thing to think about is whatever deal comes out of the auto workers strike, right, will set a precedent for all of the other smaller businesses in that supply chain. All those workers in the auto supply chain will be going, wait a minute, the guys in the plant down the road are getting paid XYZ now, and they're having their conditions XYZ. There's a feeling that this will have a multiplier effect for other factories. So there might be an inflation story out of it. But look, your point, things could still go well. Those scenarios that we talked about might play out on the upside, and the inflation story might continue to recede the way it has been, which has been very good. And then broadly speaking, yes, the US continues to be in that Goldilocks position that is into next year.
Notice, Joel, how I didn't say maybe we won't have to pay back our student loans.
Yeah,
because there are some things that are certain in life.
It's still going to be due. Exactly. I think we're going to be writing about this a lot yet, and I think how these three things evolve. I think we're in for a little bit of pain here. So, I wanted to just bring it back to that. How is this going to show up for consumers, do you think, Inda?
Keep an eye on this holiday shopping season. It will be interesting to see if the Fed does go ahead with another rate hike on this side of be Thanksgiving or Christmas time. Does that really start to hurt consumers? Do they start pulling their spending? That would be a really important signal, I think. So far, they've held up pretty well under the weight of this. So watch that. And also keep an eye on the global backdrop. China's in a funk, as we know. Maybe it's bottoming out, but it hasn't been a great year for it. Europe is certainly under pressure. The big industrial economies of Germany, for example, all of that's not a good demand story for the US either. So, there's a domestic story, and I think keep an eye on what's going on around the rest of the world as well.
Hey, listen, Darden telling us that wealthy diners are already trading down to cheaper wine.
Because they spent all their money in Europe over the summer.
So we're already seeing pressure on the pocketbook. Enda, thank you so much. We so appreciate it. Bloomberg News global economy reporter Enda Curran joining us on Zoom in our Washington, D.C. bureau. And, of course, the editor of Bloomberg Business Week, Joel Weber, here in our studio. Soft landing?
What do you think, Joel?
Looking unlikely.
I mean, look at the markets today. Look at the markets this week.
And people are talking even higher, right, in terms of the rate environment.
Yeah.
That maybe we haven't topped out on that 2-year. All right, guys, it is in the new issue of Bloomberg Business Week. Check it out on newsstands, online at Bloomberg.com/businessweek, and on the Bloomberg terminal.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, just looking through a right-through here on the Bloomberg. We've got stocks falling toward their lowest since June. I got the 10-year yields climbing. Latest reading on the labor market, reinforcing the case for the Fed's higher for longer stance. S&P 500 right now, as Charlie mentioned, down about 1.5%. Tim, all major U.S. equity benchmarks breaking below their 100-day moving averages, seen as a bearish signal by some technical analysts. So there it is, folks.
You know what looks pretty good right now?
That looks pretty good.
Money market funds that yield over 5%.
Exactly.
I don't know.
Why wouldn't you, right?
Why wouldn't you?
Exactly. Well, let's see what Hillary Kramer has to say. She's back with us. She's CIO at Kramer Capital Research. She's here in our Bloomberg Interactive Broker studio. Great to have you back with us. Why wouldn't you just throw everything in a money market right now and just don't worry about, just take all the risk off the table and just go all in?
Well, I have to say that you really do want to keep your powder dry, and it is an opportunity here. The notes I sent early this morning were, I think, a lot more optimistic than as the market started to unfold today, and I saw the bond market, leading stocks lower, and stocks in general are really weak, and it's really about earnings season. And interesting, it's the banks, especially the regional banks. These depositors are drying up, and that's one of the data points we were looking at this afternoon. We used to love U.S. Bancorp,
right?
Love it. We won't touch it right now.
We're actually going to be speaking in just a few minutes with the founder, chairman, and CEO of Connect One Bank, Frank Sorrentino. We love talking to him because regional banks are just a great read on the U.S. economy. And he can tell us, he can answer that question. Are depositors actually fleeing for high-yielding interest accounts?
And I just want to mention the KRE, the regional bank ETF, it's down about 26-27% year to date.
Yeah, and it may drop even more than that because we're just talking about depositors. What about credit quality? What about origination? Okay, it's going to take a long time to get from 7.5% mortgages down to back 4% mortgages. It doesn't just happen overnight.
So don't buy banks right now?
I would not be looking at the banks. We're going to really look to the banks to see what they have to say and what kind of color they give us on the market when they start to report earnings. And then, just think about something like restaurants. Like Cracker Barrel used to be a go-to stock. It's in the toilet. There's just no other way to put it.
Well, so what's the conviction you have in a market like this? We keep talking about what's going on with the Treasury trade, and we're talking about what the 10-year back to levels we saw in 06, 07 actually. And this just before everything started to come undone in the great financial crisis. I keep saying it doesn't feel like the great financial crisis, but it does feel like there's a lot of ifs out there. So I don't know. What's the conviction you can have in this market for either buy or not buy?
Well, there's conviction always to buy to some extent. And that's where portfolio management obviously comes into play, and making sure that you pick your points, go in slowly. But there are still opportunities out there. Yesterday's earnings, I thought that General Mills, looked really good. It was at 20% off of its highs from the year. So some of these food stocks look pretty good. We've seen just some stocks that fundamentally are good but have had issues like 3M, with their big lawsuit that they just settled.
So does that mean stock pickers market or what?
Oh, totally. It's a stock pickers market. Now, that being said, so many investors, including some of the large, smart investors, don't realize the extent to which these Magnificent Seven have just simply simply been up because everyone buys ETFs, and that's why Apple and Microsoft and Amazon continue to rise. And even today, I think Microsoft was up actually a little bit in the middle of the day. Where is it right now? It's probably about even on the day. Apple was doing okay, and that's because there is still that.
Microsoft's up about 0.25%. It was up about 1.4% earlier in the day.
Yeah, and there we go. That's pretty good. I think that.
But help me out here, because like if I bought Nvidia in January and I'm up 182%, I'm pretty happy.
That's not bad, Carol.
I was talking to my brother. He's like, "Yeah, I bought it back in 2020. I was reading about." I'm like, "Good for you, buddy." I'm like, and he's like, "I'm really happy." So I'm just wondering,
How come you're not like your brother, Carol?
I was I can't really like pick and choose stocks so easily. Doing this
That's why
job.
we do this.
Yes, exactly. So I'm just like, I hear, I don't know. What is this? What your clients tell us what they are doing and what they are concerned about, or what kind of calls you're getting from the folks that you either help manage money or give advice to.
They're sitting on their hands, and many of them are looking to sell. They're looking to liquidate. Remember, we have a very different demographic today where the next generation, whether it be lower, middle, or upper class, the parents, are paying for those that are, young adults, and there's a need for liquidity. There's a need for money that we didn't used to have in a previous time. But as a stock picker's market, like we've had a stock, I still think
that sounds to me very bearish.
But it's bearish. But remember, the Fed is going to come in and save the day. They're going to slash rates.
When?
No, they're not. No, they're not. The Fed, I thought Jay Powell was really clear yesterday.
That he might even tighten another quarter percentage point. But at the minute we have clarity.
Higher for longer. But do you think he's just over optimistic? Who thought he is? Former U.S. Treasury Secretary Larry Summers thinks that basically the Fed is, drinking the soft landing Kool-Aid.
The Federal Reserve is trying to play mind games.
Telling our David Weston that actually.
The Fed is playing mind games. I thought it was very interesting. I thought Powell was just so vague yesterday. It was very disappointing to hear him not wanting to really answer the questions in the Q&A the way he should have. But what we will see is we're going to see maybe a little bit of a bounce up, but I think we're going to see the market come back down. We're going to have, like a drawdown that could be 5 to 7% over a 2 or 3 day period.
Rival what we saw last October.
That's not so bad.
And then he comes in, and that's when we see that because he's overdone it.
But when he says he's data dependent, he's not watching the S&P 500.
Labor market's still tight. We got another reminder of that.
And CPI's, PCE is not to 2%.
Right.
Okay, well, that's something else. It's interesting, Carol, you just brought up the labor market. As soon as we see some layoffs start to happen, that's when the consumer becomes undone. That's when all bets are off and that market starts. We could see it between now and December 31. I mean, I think that there might be some gearing up. We saw Amazon hiring 250,000 employees for the holiday.
$20.50 an hour as an average wage. That's a lot of money.
Right, but AI technology, many of those jobs has really taken a lot of people out of the market.
We know the packages delivered with drones yet, Hillary. We know that the financial industry is really in dire straits right now and is actively laying off regardless of what we hear. We hear it in little bits and pieces, but there aren't those jobs out there. But the consumer is really going to get nervous. Look, Home Depot and Lowe's. Here's another proof I can have for you.
Got about 15 seconds.
Home Depot and Lowe's doing terribly today. That's proof that everyone knows you're not going to move a house in a 7.5% mortgage environment. You're just not going to. And it's not even worth trying to fix up your house to sell
unless you just had another baby. That's what we're doing. We're moving.
You are.
Did
but
you,
I heard somebody
did you have another baby?
Okay,
so you're
else
moving.
is looking and they're like, there's no inventory. Hillary Kramer, CIO at Kramer Capital Research. Be well. Thank you.
We've seen poll after poll come out saying the American people support what we are doing. In fact, polls say support for our strike is growing. That's across parties, across ages, and across Canada, and I know that all of you have been cheering them. Their fight is our fight. We've been in close contact with our Mexican union counterparts who have held demonstrations in front of GM offices in Mexico City. In Italy, 6,000 Stellantis workers recently went on strike. To our Italian union family, your fight is an inspiration. We support you, and your struggle is our struggle. From South Africa to Malaysia, we continue to receive letters and messages of strength and support, encouraging our members to hold the line and win big. And we will. So now it's time to hit the picket lines across the country. It's time to show the companies we are united and we are fired up and we are ready for a record contract. It's time to stand up against corporate greed. It's time to stand up for our communities. UAW family, I'll see you on the picket line.
I made over $10 million on Amazon. If I lost it all and had to rebuild in today's AI age, here's exactly what I would do. First, I would use
Okay, we were listening live there to the president there of the union, Shawn Fain. He was thanking workers who've been striking for their commitment to the force, also saying reinforcements are coming, that they're not going to wait around forever for a good deal. So for more on this, let's bring in Nora Naughton, who is a senior autos reporter at Insider. Thanks for being with us.
Thanks for having me.
So I want to start with asking you what the big takeaways here were. We heard there that the strikes are going to escalate, particularly at GM and Stellantis plants. What does that really mean and look like?
Yeah, so we've escalated in a couple ways here, right? The UAW has done what people have guessed that they will do, which is have the three companies compete against each other as opposed to using pattern bargaining, where the companies didn't have to compete with each other's offers. So they're happy with where things are going at Ford. That means they're moving their focus to GM and Stellantis. And in moving their focus to GM and Stellantis, they're escalating even further by choosing these parts distribution plants. That is a huge chokehold. Those are the plants that feed into the entire system. And when you lose production at those plants, that's when things at General Assemblies go down. That's when, the whole system falls apart. So this is a huge escalation in terms of work stoppage, a targeted work stoppage. And on top of that, it's an escalation across the country. So this strike becomes more visible, right? These parts distribution centers, you heard him list off how many states, how many cities that we're going to be in. That creates more visibility for this strike and puts more national pressure on these companies as people see these walkouts enter their own backyards.
So as someone on the ground there, based in an area where the auto industry booms, what does the extended strike mean for just local communities? Can they afford for these strikes to go on for weeks, like we've seen, for example, with the WGA SAG-AFTRA strikes?
Sure, there is absolutely an economic impact. It's usually very concentrated around the plant communities. Those workers are the people who get lunch and, shop for groceries on their breaks and that kind of stuff. Those people are still there. They're on strike, so they're probably not spending as much money. But, there is absolutely a local economic impact. We saw that in 2019 when GM workers went on strike. It's just a little bit more of a delayed effect. We won't see it today, but the longer that these workers stay out, the more they're going to pinch pennies. And they're a huge part of this community. I mean, not only am I based here, but I grew up here, and there's not a single family that isn't touched by some form of automotive work. So it has the potential to really do a lot to the local economy.
And Nora, I think it's important to mention, too, that the people who are going on strike right now are not getting their full pay during this time. How long can some of these folks really afford to continue striking?
Yeah, they are living off of strike pay. And depending on your state, they could qualify for some supplemental unemployment. But it is a big sacrifice that workers on strike are making. I think it depends on the worker. I know the UAW and other unions tend to prepare their members ahead of a work stoppage and talk about savings and, putting things aside if you know that you're going to be going without. But again, these workers are fighting for better wages and talking about things like living at or below the poverty line. So these are already people that struggle to make ends meet. So the longer this stretches on, the worse the personal economic impact becomes.
Okay, we'll have to leave it there, but lots to follow on this story. Nora Naughton, thanks for your time.
Thank you for having me.